I miss traveling, yeah.
Even if you can't travel, your money still can.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Why put all your eggs in one basket?
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
So what are the advantages of investing in index funds? Before coming to advantages, it's important to understand that index funds are actually very popular in many countries across the world. So markets such as the US today, index funds and ETFs, passive funds, are now over half the mutual fund AUM. So they've become increasingly popular, and I think the main reasons is three things. Index funds are extremely easy to understand. They are extremely economical, so they're low cost, and they're also very effective when it comes to long-term returns. So let's come to the first point. Index funds are extremely easy for a investor. Why? Because for an investor who wants to say buy a mid-cap fund or a small-cap fund, instead of him having to choose between hundreds of funds out there, it makes sense for him to just buy the mid-cap strategy and hold on to it for a very long time. So it's very easy and makes investing very simpler in the long run. Number two is economical. Index funds are actually one big reason to why they're very popular is because of their low-cost nature. Index funds do not require fund managers or any sort of decision making that's happening from the fund from any person. So which is why I think today index funds in India and across the world are available at say 1/10 or even 1/15 the cost of an active fund. And third is it's very effective. If you see the returns of index funds over a very long time perspective, they've actually done phenomenally well, especially over long time periods. And I think the track record of index fund, which spans 15 to 20 years, shows that I think for anyone who's looking to invest for very long time periods will be very happy with index funds.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello everyone, I'm Pratik Oswal, Head of Passive Funds at Motilal Oswal Asset Management Company. I hope all of you had a very good Diwali and hope you have a great New Year as well. So today I'm here to talk about a new fund launch that the mutual fund company is launching, and I'm extremely excited to talk about the fund that we're launching based on the success that we've had in our international funds, specifically our very famous NASDAQ 100 ETF and FOF, as well as the S&P 500 index fund. We are now launching a third fund
which is now a non-US fund. So both of our first funds were focused in the US. Today we're launching, extremely excited to launch a developed markets index fund, which is going to be focused on a lot of countries outside the US. So what is this fund? It's called the Motilal Oswal MSCI Top 100 Select Index Fund. So it's essentially an index fund that invests into the top 10 countries outside the US and the top 100 companies within that. So we are giving access to investors to some of the best names, the best brands, the best companies outside the US. And we do believe that this fund is essential for your portfolio diversification needs. You know, I have said this before that India is only 3% of the entire global GDP, and we are missing out on 97 to 98% of wealth creation opportunities outside of India. And this fund gives you access to a part of the planet that makes 30% of entire market share of the world. So I do believe, and so the main reason to why you should invest in this fund is to diversify your Indian portfolio. And we all know that the US is a great story, but it's also important to look at other parts of the world as well, which is where this fund comes in. You are investing in brands like Nestle, Roche, AstraZeneca, Sony, Louis Vuitton, and some of the best companies, best brands in Europe, UK, and Japan. And we believe that this fund can be extremely effective for portfolio diversification. It can be extremely helpful to lower the risk in your portfolio and to also have a portfolio that's geographically diversified, which can get you really good returns over the long term. So thank you so much. Looking forward to all your support in this fund, and please stay tuned for a lot more funds coming in from the Motilal Oswal Fund House. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Equity investing has got fancy of everyone around us, and why shouldn't it? Equities have helped investors create tremendous wealth over the long term, but it's not easy for an investor, as there are thousands of stocks to choose from and hundreds of mutual fund schemes to select from. That's where investors can consider passive investing approach, which simply tracks and invests in the portfolio of a market-wide index. Unlike active investing, wherein the fund manager takes investment decisions to buy or sell every stock of the portfolio, under passive investing, fund manager has to replicate the index portfolio and manage stock-level asset allocation accordingly. One of the most common forms of passive investing is index fund. An index fund represents a basket of stocks that mirror the securities of an index, such as the Nifty or the Sensex, to match the performance of an index. So, an index fund tracking the Nifty 50 index would invest in the same 50 companies and in the same proportion as the Nifty 50 index. Index investing offers ease, as you just have to select the index and your investment will be diversified across numerous stocks and various indices or various sectors at the click of a button. You do not have to even worry about rebalancing the portfolio based on any changes in the underlying index. Economy, as they usually have significantly lower expense ratio as compared to active funds, and even costs less than buying those stocks individually, because it doesn't require active fund management to select stocks or formulate investment strategies. That's why there is a significant increase in the corpus in index funds over the years, from 20 billion in 2009 to 800 billion in 2018. Effectiveness, as the historical performance of Sensex for various periods is an evidence that investing in an index fund has resulted in significant wealth creation over the long term. No wonder why many successful investors recommend index funds to new as well as existing investors because of its low cost, simplicity and effectiveness. What's more, index or passive funds are one of the most sought after investment product. It has been growing in popularity world over, and India is no exception. So if you're not certain about which stocks to go for, wish to invest for the long term, and want to stay away from constant monitoring and reshuffling your portfolio, invest in index funds of your choice today and enjoy low-cost investing. Passive funds also include ETFs. We will learn more about ETFs in our subsequent videos. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
I miss traveling, yeah.
Even if you can't travel, your money still can.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Why put all your eggs in one basket?
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
So what are the advantages of investing in index funds? Before coming to advantages, it's important to understand that index funds are actually very popular in many countries across the world. So markets such as the US today, index funds and ETFs, passive funds are now over half the mutual fund AUM. So they've become increasingly popular, and I think the main reasons is three things. Index funds are extremely easy to understand. They are extremely economical, so they're low cost, and they're also very effective when it comes to long-term returns. So let's come to the first point. Index funds are extremely easy for a investor. Why? Because for an investor who wants to say buy a mid-cap fund or a small-cap fund, instead of him having to choose between hundreds of funds out there, it makes sense for him to just buy the mid-cap strategy and hold on to it for a very long time. So it's very easy and makes investing very simpler in the long run. Number two is economical. Index funds are actually one big reason to why they're very popular is because of their low cost nature. Index funds do not require fund managers or any sort of decision making that's happening from the fund from any person. So which is why I think today index funds in India and across the world are available at say 1/10 or even 1/15 the cost of an active fund. And third is it's very effective. If you see the returns of index funds over a very long time perspective, they've actually done phenomenally well, especially over long time periods. And I think the track record of index fund, which spans 15 to 20 years, shows that I think for anyone who's looking to invest for very long time periods will be very happy with index funds.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello everyone, I'm Pratik Oswal, Head of Passive Funds at Motilal Oswal Asset Management Company. I hope all of you had a very good Diwali and hope you have a great New Year as well. So today I'm here to talk about a new fund launch that the mutual fund company is launching, and I'm extremely excited to talk about the fund that we're launching based on the success that we've had in our international funds, specifically our very famous NASDAQ 100 ETF and FOF, as well as the S&P 500 index fund. We are now launching a third fund, which is now a non-US fund. So both of our first funds were focused in the US. Today we're launching, extremely excited to launch a developed markets index fund, which is going to be focused on a lot of countries outside the US. So what is this fund? It's called the Motilal Oswal MSCI Top 100 Select Index Fund. So it's essentially an index fund that invests into the top 10 countries outside the US and the top 100 companies within that. So we are giving access to investors to some of the best names, the best brands, the best companies outside the US. And we do believe that this fund is essential for your portfolio diversification needs. You know, I have said this before that India is only 3% of the entire global GDP, and we are missing out on 97 to 98% of wealth creation opportunities outside of India. And this fund gives you access to a part of the planet that makes 30% of entire market share of the world. So I do believe, and so the main reason to why you should invest in this fund is to diversify your Indian portfolio. And we all know that the US is a great story, but it's also important to look at other parts of the world as well, which is where this fund comes in. You are investing in brands like Nestle, Roche, AstraZeneca, Sony, Louis Vuitton, and some of the best companies, best brands in Europe, UK, and Japan. And we believe that this fund can be extremely effective for portfolio diversification. It can be extremely helpful to lower the risk in your portfolio and to also have a portfolio that's geographically diversified, which can get you really good returns over the long term. So thank you so much. Looking forward to all your support in this fund, and please stay tuned for a lot more funds coming in from the Motilal Oswal Fund House. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Equity investing has got fancy of everyone around us, and why shouldn't it? Equities have helped investors create tremendous wealth over the long term, but it's not easy for an investor, as there are thousands of stocks to choose from and hundreds of mutual fund schemes to select from. That's where investors can consider passive investing approach, which simply tracks and invests in the portfolio of a market-wide index. Unlike active investing, wherein the fund manager takes investment decisions to buy or sell every stock of the portfolio, under passive investing, fund manager has to replicate the index portfolio and manage stock-level asset allocation accordingly. One of the most common forms of passive investing is index fund. An index fund represents a basket of stocks that mirror the securities of an index, such as the Nifty or the Sensex, to match the performance of an index. So, an index fund tracking the Nifty 50 index would invest in the same 50 companies and in the same proportion as the Nifty 50 index. Index investing offers ease, as you just have to select the index and your investment will be diversified across numerous stocks and various indices or various sectors at the click of a button. You do not have to even worry about rebalancing the portfolio based on any changes in the underlying index. Economy, as they usually have significantly lower expense ratio as compared to active funds, and even costs less than buying those stocks individually, because it doesn't require active fund management to select stocks or formulate investment strategies. That's why there is a significant increase in the corpus in index funds over the years, from 20 billion in 2009 to 800 billion in 2018. Effectiveness, as the historical performance of Sensex for various periods is an evidence that investing in an index fund has resulted in significant wealth creation over the long term. No wonder why many successful investors recommend index funds to new as well as existing investors because of its low cost, simplicity and effectiveness. What's more, index or passive funds are one of the most sought after investment product. It has been growing in popularity world over and India is no exception. So if you're not certain about which stocks to go for, wish to invest for the long term, and want to stay away from constant monitoring and reshuffling your portfolio, invest in index funds of your choice today and enjoy low-cost investing. Passive funds also include ETFs. We will learn more about ETFs in our subsequent videos. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
I miss traveling. Yeah.
Even if you can't travel, your money still can.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.
Why put all your eggs in one basket?
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.
So what are the advantages of investing in index funds? Before coming to advantages, it's important to understand that index funds are actually very popular in many countries across the world. So markets such as the US today, index funds and ETFs, passive funds are now over half the mutual fund AUM. So they've become increasingly popular, and I think the main reasons is three things. Index funds are extremely easy to understand. They are extremely economical, so they're low cost, and they're also very effective when it comes to long-term returns. So let's come to the first point. Index funds are extremely easy for a investor. Why? Because for an investor who wants to say buy a mid-cap fund or a small-cap fund, instead of him having to choose between hundreds of funds out there, it makes sense for him to just buy the mid-cap strategy and hold on to it for a very long time. So it's very easy and makes investing very simpler in the long run. Number two is economical. Index funds are actually one big reason to why they're very popular is because of their low cost nature. Index funds do not require fund managers or any sort of decision making that's happening from the fund from any person. So which is why I think today index funds in India and across the world are available at say 1/10 or even 1/15 the cost of an active fund. And third is it's very effective. If you see the returns of index funds over a very long time perspective, they've actually done phenomenally well, especially over long time periods. And I think the track record of index fund, which spans 15 to 20 years, shows that I think for anyone who's looking to invest for very long time periods, will be very happy with index funds.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.
Hello everyone, I'm Pratik Oswal, Head of Passive Funds at Motilal Oswal Asset Management Company. I hope all of you had a very good Diwali and hope you have a great New Year as well. So today I'm here to talk about a new fund launch that the mutual fund company is launching, and I'm extremely excited to talk about the fund that we're launching based on the success that we've had in our international funds, specifically our very famous NASDAQ 100 ETF and FOF, as well as the S&P 500 index fund. We are now launching a third fund, which is now a non-US fund. So both of our first funds were focused in the US. Today we're launching, extremely excited to launch a developed markets index fund, which is going to be focused on a lot of countries outside the US. So what is this fund? It's called the Motilal Oswal MSCI Top 100 Select Index Fund. So it's essentially an index fund that invests into the top 10 countries outside the US and the top 100 companies within that. So we are giving access to investors to some of the best names, the best brands, the best companies outside the US. And we do believe that this fund is essential for your portfolio diversification needs. You know, I have said this before that India is only 3% of the entire global GDP, and we are missing out on 97 to 98% of wealth creation opportunities outside of India. And this fund gives you access to a part of the planet that makes 30% of entire market share of the world. So I do believe, and so the main reason to why you should invest in this fund is to diversify your Indian portfolio. And we all know that the US is a great story, but it's also important to look at other parts of the world as well, which is where this fund comes in. You are investing in brands like Nestle, Roche, AstraZeneca, Sony, Louis Vuitton, and some of the best companies, best brands in Europe, UK, and Japan. And we believe that this fund can be extremely effective for portfolio diversification. It can be extremely helpful to lower the risk in your portfolio and to also have a portfolio that's geographically diversified, which can get you really good returns over the long term. So thank you so much. Looking forward to all your support in this fund, and please stay tuned for a lot more funds coming in from the Motilal Oswal Fund House. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Equity investing has got fancy of everyone around us. And why shouldn't it? Equities have helped investors create tremendous wealth over the long term. But it's not easy for an investor, as there are thousands of stocks to choose from and hundreds of mutual fund schemes to select from. That's where investors can consider passive investing approach, which simply tracks and invests in the portfolio of a market-wide index. Unlike active investing, wherein the fund manager takes investment decisions to buy or sell every stock of the portfolio, under passive investing, fund manager has to replicate the index portfolio and manage stock-level asset allocation accordingly. One of the most common forms of passive investing is index fund. An index fund represents a basket of stocks that mirror the securities of an index, such as the Nifty or the Sensex, to match the performance of an index. So, an index fund tracking the Nifty 50 index would invest in the same 50 companies and in the same proportion as the Nifty 50 index. Index investing offers ease, as you just have to select the index and your investment will be diversified across numerous stocks and various indices or various sectors at the click of a button. You do not have to even worry about rebalancing the portfolio based on any changes in the underlying index. Economy, as they usually have significantly lower expense ratio as compared to active funds, and even costs less than buying those stocks individually, because it doesn't require active fund management to select stocks or formulate investment strategies. That's why there is a significant increase in the corpus in index funds over the years, from 20 billion in 2009 to 800 billion in 2018. Effectiveness. as the historical performance of Sensex for various periods is an evidence that investing in an index fund has resulted in significant wealth creation over the long term. No wonder why many successful investors recommend index funds to new as well as existing investors because of its low cost, simplicity and effectiveness. What's more, index or passive funds are one of the most sought after investment products. It has been growing in popularity world over and India is no exception. So if you're not certain about which stocks to go for, wish to invest for the long term, and want to stay away from constant monitoring and reshuffling your portfolio, invest in index funds of your choice today and enjoy low-cost investing. Passive funds also include ETFs. We will learn more about ETFs in our subsequent videos. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
I miss traveling, yeah.
Even if you can't travel, your money still can.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Why put all your eggs in one basket?
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
So what are the advantages of investing in index funds? Before coming to advantages, it's important to understand that index funds are actually very popular in many countries across the world. So markets such as the US today, index funds and ETFs, passive funds are now over half the mutual fund AUM. So they've become increasingly popular, and I think the main reasons is three things. Index funds are extremely easy to understand. They are extremely economical, so they're low cost, and they're also very effective when it comes to long-term returns. So let's come to the first point. Index funds are extremely easy to
Good evening, friends, and welcome to the first edition of the Motilal Oswal Passive Funds Conclave. My name is Pratik, and I'll be your anchor for the evening. We have for you a very exciting date lined up for all of you. So we have a really good lineup of star-studded speakers, industry experts from local as well as international markets. And we're very excited to experience this day with all of you. We also have a short window for Q&A for each of our speakers. So, all of you watching out there, please make sure that you use the YouTube to, put your comments and questions, and we'll definitely, get to them during the Q&A session. In the last couple of decades, or at least in the last 2 years in India, index investing or passive fund investing has gained a lot of ground for millions of investors in India, and when I say passive funds, I mean ETFs, I mean index funds, and we believe that this has a huge role to play as more and more Indians, create wealth by investing in equities. We all believe that, investing in equities is essential, for long-term wealth creation. And, index funds is one such category where we feel it's extremely simple, and also low cost, and has given excellent returns to a lot of investors globally. So before I go to my first speaker, I just wanted to maybe take a minute or two to talk about what index funds are. I've been talking about that for very long time. But what are passive funds? So passive funds are essentially mutual funds that have two different types. One is called index fund. The other one is called an ETF. The full form of an ETF is an exchange traded fund. So essentially, an index is like a basket of securities. I'm sure a lot of you would have heard of Nifty, Sensex, that they are basically broad indicators of how the markets are, and and they are now available for people to invest. So if you invest in a Nifty based index fund, then if the Nifty goes up by 10%, then your portfolio also goes up by 10%. So it's very simple. You don't have to worry about selecting the right stock. You don't have to worry about selecting the right fund manager. You can just buy the index, and that's good enough for your long-term sort of wealth creation. ETFs are like index funds, but are listed on the exchange. So you can buy ETFs just like buying stocks on the exchange. So these are the different types of index funds. So for today, we are going to have a lot of speakers talking about the importance of index fund in your portfolio. And we'll also obviously be able to answer a lot of questions on, are they good enough for investing? What are some of the benefits of having index funds? How do they play a strong role in asset allocation? And what are some of the options available in India today when you have to go out there and put your money in index funds? So without taking more of your time, I'm extremely excited to, invite our first speaker of the day, who will be giving a warm introduction to all of our speakers coming in. So we have Mr. Navin Agarwal, who's the MD and CEO of Motilal Oswal Asset Management Company. So he'll be delivering a welcome address for all our speakers. So over to you, Navin.
Thank you, Pratik, and very warm welcome to all of you once again to this Passive Funds Conclave. For those of you who may not recollect, Motilal Oswal actually launched its first ETF conclave nearly a decade back, when hardly anybody was talking about these things, because we were watching the US really gain in terms of its size and share and of the passive business. And just by way of context, when I was looking at numbers, it's really astonishing that passive funds now account for over 40%, nearly 43% of all funds, mutual funds in the US, with nearly $10 trillion of AUM. However, if you zoom in further and deep dive, passive funds now account for a majority of equity funds in the United States. And in fact, as you look back, for the last several years, since 2013, passive funds have been increasing as a proportion of the total AUM by about 2.5% every year. So every 4 years, there's a 10 percentage point shift in favor of passive within the world's largest equity markets, which is the United States. And the trends in India have also been very exciting, very encouraging. So I remember 5 years back when we were far smaller in this business and the business itself was very tiny. all funds in India collectively manage 35,000 crores of AUM. And 5 years fast forward into September of this year, this number was over 4 lakh crores. By context, I spoke about US having 43% of all AUM in passive. India with 4 lakh crores is just over 10% of the total AUM of about 35, 40 lakh crores, 37, 38 lakh crores right now. So the runway is clearly quite a long one. And we've already seen a 10x plus in a space of just 5 years alone. So while US may be gaining at the rate of 2.4% per annum, I think India is also roughly gaining 2% share per annum. And if you were to extrapolate these trends, clearly, there is a very, very exciting future ahead for these funds. But this excitement will have to be combined with understanding the investor needs, understanding the gaps in terms of the diversification needs of the investors, and coming up with innovative products rather than just me-too products. And right from the word go, Motilal Oswal Asset Management has been doing exactly that. So, we entered the passive business actually 12 years ago, back in 2010, when Smart Beta was not such a well-known thing, and we launched our first Smart Beta product in July of 2010. We then followed this up with India's first NASDAQ fund in March of 2011. And back then, NASDAQ had a very rough time, having peaked out in 2008, and there was all the gloom and doom around it. While it was a great time to launch the fund, it was definitely not a great time to mobilize money. We could hardly convince anybody 11 years back to invest in a US fund, and particularly NASDAQ fund, after the index there had corrected so much. And guess what transpired since then? An investor who invested 1 crore rupees at the launch of this fund in March of 2011, that crore is now more than 11 crores. The money has compounded in INR terms at over 25% every single year. And as I speak to you today, I'm very happy to announce that between the fund of fund, the NASDAQ franchise today in India, which was launched 11 years back, has crossed 10 or is nearly at 10,000 crores. So this really added a lot of value to every investor, compounding their wealth at a time when the Indian equities themselves had a lukewarm decade, giving you mid-single digit returns when NASDAQ gave you these 25% returns. In fact, this was not the only first to our credit, the Smart Beta product and NASDAQ. We actually followed it up with India's first Nifty 500 index fund, which was launched in September of 2019. And then the S&P 500, the mother of all funds, launched in April of 2020. And there too, investors have reaped rich rewards. The returns on the S&P 500 fund ever since the launch in IRR terms is nearly 32.9%. So a fantastic journey. We think that this is just the beginning of the journey, courtesy some of these unmet needs of diversification of the Indian investor. And that is a very large and a fast-growing savings pool. We are very excited that there are so many white spaces out there for products to be launched, for innovations to happen, for risk-reward equation to be improved through diversification. So we're looking forward to launching many, many more products in the coming years. And we believe that through this innovation, we can really drive the overall growth of the entire Indian passive ecosystem in a very sustainable way. So once again, as Pratik said, we have a very exciting lineup of speakers today. I once again extend a very warm welcome to all of you. And we are very excited to present these interesting speakers today, and also to launch more and more innovative products. As I speak to you, we've just launched the EFA product, the Europe and Far East product. And we have another interesting product, the emerging market product, and the Q50 that's coming up in the coming months. So watch out for this space, and watch out for these conclaves year after year for a lot more investing wisdom on the passive funds business as well. Thank you all for participating, and have a great time today.
Thank you. Thank you, Navin. That was wonderful. Thank you for giving us a great background about where we have come from in the last 10 years, and we obviously look forward for the next 10 years, in building the business and providing customer-centric products and solutions to all of our investor base, going forward. So I am the first speaker for today. So for those who don't know me, I'm Pratik Oswal. So I head the passive funds business at Motilal Oswal Asset Management Company. I have been doing this for the last 2.5 years, and it's been a lot of fun. And we've managed to convert a lot of customers in prospects into customers into a lot of our funds today. And today, I will be giving a very brief background about the past, present, and future of passive investing, from an Indian standpoint and also, from a global standpoint. I look forward to having a great conversation, and obviously, we will follow it up with some Q&A. And please do, comment on our YouTube channel, for questions from the audience. So I hope all of you can see my presentation, and so I will talk for about 15-20 minutes, and then we can open it up for Q&A after that. So today I'm going to be talking about the past, present, and future about passive investing. What has happened in the past, what is happening right now, and what we, at least as product experts, expect to happen over the next 5 to 10 years time. So very exciting stuff that's happening in this space. So when it comes to passive investing, most people tend to talk about just Nifty 50 or a Sensex fund. Those are the two most popular, funds in India. But they are the most popular as well with investors. But most people, a lot of investors don't know that there's a world beyond Nifty and Sensex. We have, I think 2 years ago when I started, there wasn't a lot of options to invest, and today we have a flurry of options in the Indian market ecosystem across various AMCs who are doing a fabulous job in educating people on what index investing is. But just to I think give a very brief background about what we have. We have passive investing, as I said, is beyond Nifty and Sensex. And what do we have today? We have domestic equity. So today investors can invest not only in Nifty and Sensex, but also in mid cap funds, in small cap funds, in multi cap funds, and also in sector funds and ETFs. So you have got a whole list of funds that are available, low cost funds that are available for people, for them to pick and choose. So a lot of options in domestic equity. Within passive funds, there's also I would say a universe called smart beta or strategy funds, which I will come to later on. But essentially, investors who want to get access to a strategy like momentum or low volatility can really make use of strategy indices, which are now coming. There's very few options today, but you will see a lot more options coming in over the next 6 to 8 months time. A big category that has come in the last 2 years especially has been debt index funds and ETFs. So I think index funds and ETFs or passive funds were not extremely popular with debt because it's a slightly more complicated asset class. But today you have a lot of funds happening in debt, which I think is one of the fastest growing categories in India. So, and there's lots of options coming out there as well. You also have commodity, so gold ETFs, gold funds are very popular for investors today. They offer great diversification of your portfolio. A lot of investors choose to have gold, and now hopefully over the next 6 months, investors will also see silver funds coming in the market. So a lot of stuff happening in the commodity space as well. And lastly, international. Which I think it has been a great story over the last 2 years. Investors today have access to global funds with the click of their fingers, which is not only increased returns but will also reduce your portfolio volatility, which I'll come to later on. So a lot of options today for investors when it comes to passive funds, and the world has sort of moved beyond Nifty 50 and Sensex, which a lot of options today overall. So this is what I spoke about earlier. As I said, domestic equity is your most popular asset class, where you have funds across these 6 spectrums. You also have strategy indices. So these are indices where investors can buy a fund which has a momentum strategy or a quality strategy or an equal weight or even ESG is a strategy index. So a lot of options available within strategy also. Also in debt, as I talked about, there's a lot of options available for investors today. So overall, I think, you will see a huge, flurry of products, a lot more products coming in the market over the next, I would say, a few years. Also within international, you have themes. You can invest in, China. You can invest in, the lot of broad-based indices like S&P 500, Nasdaq. We are obviously offering you a developed markets index, and we'll be coming up with an emerging market fund as well. So a lot of options happening for international diversification, which we believe is very important for the investor. So let's look at the past of passive funds. There has been a good history in passive funds. They've been around for almost, I would say, almost over, close to 20 years. And but for the first 15 years, we didn't see a lot of growth for passive funds because I think there wasn't a lot of information out there, and also the returns of passive funds were not as competitive, compared to other funds in the market. But today, I think that has changed. As you can see from this graph, you had very less or very small funds, happening. So, for example, in international space, in say, about 2 years back, you had about just 200 crore within international passive funds, which has grown to close to 9,000 crores. In debt, you have grown the last 2 years from 2,000 crores to 52,000 crore. And obviously, even within equity, which is the fastest growing segment today, you have seen a huge amount of growth in the last 5 years. So it's getting a lot of grounds. Yes, a lot of this is coming from pension funds, which have been instrumental in building this ecosystem. But now over the last 2 years, we have seen a huge number of customers, I would say millions of investors who are now buying index funds, ETFs, through the various broker platforms, and also a lot of mutual funds coming in with this also. So a lot of growth ahead. As you can see, the 5-year growth for this category is quite large if you look at it, and we expect this growth to continue in the future as well. Why? So we've seen growth, but why are index funds or ETFs, both come under passive funds? Why are they popular? Why are people talking about them today? And I think number one, there wasn't a lot of education on passive funds. I would say a few years ago, I think they weren't as popular. But today, I think a lot of education is happening from various people across India. The number one reason to why at least we feel why index funds are great is because of 3 E's. It's called easy, effective, and economic. So the 3 E's that we think why index funds are very popular. One is it's simple to understand. Very simple. Today, if you had to buy a mid cap fund today, for someone who is not having access to a high quality advisor, it's very daunting task. You have to choose between the 50 or 100 mid cap funds, and you have to choose one. So you don't have to do that with index funds. You just can pick up mid cap index fund, and the returns are pretty much the same. The costs are low, so it's a very easy way of investing. We believe that one reason why a lot of Indians have not really invested in equity is because equity is very complicated. And we believe that index funds will really lead to a lot more people coming in and building wealth through equities. Again, the second reason is economic. Index funds are very low cost. So one big reason to why people like index funds is because they're very cost effective. So more of your money is invested in the underlying stocks. So extremely important. For people who are investing for say 20, 30 years, they can expect a lot of savings happening from the low cost. And third is very effective. I think it's great for asset allocation. The returns we've seen, index funds have a track record of 15 to 20 years, over long-term periods. And we have seen that the growth rates have been quite significant. So returns have been great. They're very simple and they're very low cost. These are some of the reasons to why index funds are extremely popular. Just a trivia for people who are watching this. What do you think the current share of passive funds in India is? So if you look at the entire sort of equity universe of India, where do you think index funds are today, or even ETFs are combined, passive funds in general? Where are we today? And the answer is close to 20%. So 20% of our entire mutual fund universe is invested in passive funds, which I think is a very, very large number. Again, just to put the caveat that most of this 20% is due to institutions, pension funds. but we are seeing a lot of investors who are now, I think investing in passive funds. So as you can see from the chart out here, you had close to zero growth, till about March 2015 or 16, after which, demand for these products have completely exploded. So we've seen huge demand for our products as well as huge demand for, funds in general in the space. And we believe that this can really, make investing easy for a lot of our customers. So what about the future of investing? What we've seen is that, and India tends to be, if you look at the US tends to be about 5 to 10 years ahead of India. If you look at the history of finance, and today in the US, as Navin pointed out earlier, more than half of the mutual fund industry is actually passive funds, and mostly ETFs, which was about, I would say about 10 to 15% about 12 years ago. So you have seen an explosion in AUM when it comes to passive funds, and we will see similar impact out here. At least if India manages to follow the US over the next 5 years or 10 years, we will see a similar impact happening out here over the next 10 years, where a lot of incremental or new flows will come into passive funds because of how simple they are in general. So I talked about what index funds are, and why it's popular, and why they're extremely effective for to make sure that they can be excellent for investing. Now let's come to a new category of investing which wasn't there about 2 years ago, which I think is extremely exciting, and that's one area where at least we at Motilal Oswal are currently experts, not experts, but we understand it really well. We've been focused on that for the last 2 years, and we've had good success in the international fund space. And that is international investing. We believe that if you look at any investor outside of India, or most investors, they would have about 20 to 30% of their investments outside of their home country. So if you live in the US, then 20 to 30% of your money will be outside the US. If you live in, say, UK, then about 20, 30, even 40% of your money is outside the UK. So this is very normal for a lot of investors, globally, and that is something which was missing, when I started looking at this space about 2 years ago, and we decided to, go out there and talk about the importance of international diversification, which is what we are extremely excited about. So as Navin said, our Nasdaq fund is probably the India's largest international fund today, and we also have the S&P 500. But overall, it's very important for investors to know that close to 97% of wealth creation opportunities today are actually outside of India. So we are about 3% of global GDP market share, of market cap, and obviously India has great prospects. You should have most of your money in India and all of that, because we understand the Indian economy better. But it's also important that we look at opportunities outside also. Previously, there weren't that many options, but now you have so many options with so many funds out there who are giving you access to global markets. And we obviously, if you look at this chart on the left, the US is about 55 to 60% of the entire world, followed by developed markets and then emerging markets. So very important point that there are a lot of wealth creation opportunities outside, and we ideally should look at outside India, at least small part of your portfolio, to make sure that we have diversification for our portfolio. And we believe that the main reason to why investors should look outside is actually diversification. Yes, we have seen that the US has done phenomenally well in the last 10 years, but we believe that the true reason to why you should put your money outside, or at least invest in international funds, is to diversify. What we've seen is US markets, European markets, Indian markets, tend to move in different directions while giving you the same return. What does that mean? That means you can get the same returns as what you would make in India, but you could lower your portfolio volatility in a big way. So suppose tomorrow India does badly, you have your US and European exposure to make sure most of your portfolio doesn't go down. And vice versa, if the US is not doing well, and you have your Indian portfolio to give you those stability in your portfolio. So it's extremely important, to use international funds as a way of diversification, as a way of lowering a portfolio volatility. And also, it gives you access to dollar return, which I think is very important. So the rupee, unfortunately, has depreciated by about 5% every year in the last 10 years against against the dollar, and international funds will give you that extra 5% returns because you're investing in, I would say, a US currency. So, for example, take an example of our Nasdaq fund. It's done about 25% over the last 10 years. But if you take out the rupee dollar returns, it's about 20%. So you're getting additional returns because you're investing in a US based index. What you're also getting is, very important is that today a lot of our expenditure is also happening in dollar. We are buying iPhones, we are buying lots of goods and services. We are traveling abroad, we are sending our kids to schools in the US. So it's important to have some of your portfolio in dollar-based, companies, which I think is very important. And thirdly, you are getting access to some wonderful companies. I think we all do want to own shares in companies like Tesla or Google or Nestle or SoftBank or Sony, which is now being available to a lot of investors through international funds. So very important, I think, international investing. We believe that it should be part of your 15-20% of your portfolio. And as I said, these are some of the global brands that you could buy from any of our mutual funds. Is also a lot of other mutual funds which are equally good. But we believe that it's important to diversify. Having a reliance in Infosys is very important in your portfolio. But I think these companies are also household brands today in India, which is where international investing comes in. So let's talk about the future as well. I talked about global and US. We saw that the futures. There's a lot of, I think, in the future we're seeing a lot of growth coming from passive funds. They will become a large part about, may not be the largest segment in India, but will definitely be a lot bigger than where they are today. And as we can see, the global market share of passive funds in 2010 versus 20 is very different, in terms of, how they have done over time. So, we believe that it's good opportunity for investors. And as I said, passive funds, it does not have to be a Nifty or a Sensex fund. It will come in the form of a thematic fund, a sector fund, a commodity like gold or silver is also part of passive. You have international funds. So a lot of new innovative funds can happen through passive, which we're very excited about. So, I think, why should you invest in a passive international fund? Unlike in Indian equity, where both active and passive funds are equally good in terms of how they do performance. When it comes to international markets, we do believe that passive funds make life simple. You don't have to worry about which fund to buy, which fund to sell. And also, I think what we've seen is when international markets, passive tends to beat 90-95% of all other funds, and they're also low cost, so investors don't have to worry about the cost first. So I think overall, I think we believe that at least when it comes to international allocation, passive is something which we believe is a good option for investors, at least to keep things simple. So I talked about the past and the present, so I'll quickly talk about the future now. So what is the future going to be? And a very, very exciting future about passive funds. Obviously we have seen passive funds take off in a very big way. But we believe that at least we at Motilal Oswal believe that the future of investing, it's not going to be trying to buy this fund versus that fund, but the future of investing is going to be focused on asset allocation. What is asset allocation for like a lot of people out here? So asset allocation is basically how you would split your assets. So suppose you have to invest 100 rupees today. How you would invest 100 rupees in equity versus debt versus international versus gold versus real estate versus a liquid fund like cash. So that decision about how to sort of invest your money in different asset classes is what asset allocation is about. It's the most popular way of investing globally. We believe that the future of investing is going to be asset allocation, where an investor today spends most of his or her time trying to select the right fund or trying to select the right stock right now. But we believe that may not be as that may not be as fruitful, or that may not be as important as I think creating an asset allocation. So what is an asset allocation? I think the whole point about asset allocation is to really figure out what your risk is. So today a lot of investors really don't know what their risk what their risk profile is, or how much risk are they willing to take in the markets. And that's a big problem because people don't know how much risk to take at what times. When markets are bad, people tend to de-risk their portfolios, and when markets are good, people tend to take more risk, which I think is a very bad strategy and leads to a lot of wealth destruction. So we believe that I think an asset allocation approach where you have fixed amount of money in your portfolio based on your risk profile is something that we believe is probably going to be the future, as it has in other countries. And the reason why passive funds are really great is because they make they make asset allocation extremely simple. Suppose you decide that I want to put 40% or 50% of my money in equity. You can just put your money in a simple large and mid cap index fund or an ETF, and you will be done with that. So I think when people talk about financial planning, then they can really decide about how to invest your money. So I'll give an example of what an asset allocation is and how it can be very effective. These are two strategies, very simple. The yellow one is gold. The yellow one is equity. The green one is international. You have gold and you have debt. And one strategy is 65% equity, and the second strategy is about I would say 35% equity. So one's aggressive portfolio, one's a conservative portfolio, and this is how I would say a lot of people across the world would I would say manage their money. And when it comes to the returns, what we've seen is that an asset allocation approach would actually give you higher returns than what you would make in a plain vanilla index Nifty 500 fund, which is 100% equity. So what you're getting in asset allocation is higher returns actually over the long term, as you can see from the slide, with lower volatility. So you're getting a portfolio which is a lot more stable, and you're getting a portfolio which is slightly higher performing than what you would make in a traditional fund, which I think is a great proposition to have for all investors. So we believe that this can be a great way of managing money in the future. So how important is asset allocation? I talked about what asset allocation is. It's about how you spread your money over different asset classes, and we as investors today spend I would say approximately maybe 70, 80, 90% of our time trying to select the right fund, or trying to select which fund to buy, which fund to sell. But as you can see, it may not be as important over the long term, how you split your money between equity and debt and gold. I think long term, say over 10 to 15 years, that decision is a lot more important than trying to select the right fund or trying to time the market. I will enter today, I will exit tomorrow, which is also not a great strategy for investors. I think the best way to invest is to just I would say buy and buy and sit tight, which is we think is the best strategy for investors for the long term. So as I said, asset allocation is a strategy that decides 90% of your returns over the long term. So if you made a lot of money over the next 10-15 years time, 90% of that reason of why you made so much wealth is actually due to asset allocation, as opposed to this fund versus that fund. And this is where passive funds really come into the picture, overall. So with that, I think I will end my presentations out here, and we'll open it up for a short Q&A round with Mahavir right now. Thank you so much.
Sure. Thanks so much, Pratik, for taking us through the journey of passive funds in India and also sharing your thoughts. We have a lot of interesting questions from the audience, and I'll take them one by one. So first question is actually, which passive fund or ETF is good for the long term? Any comments from you, Pratik, on this?
Yeah, so a lot depends on what your goals are and what your risk profile is. So there are funds across many things. There's funds across large cap, mid cap, small cap. There's so many funds out there. I would say that a simple Nifty 500 fund, which gives you access to a large, mid, and small, is good enough for your portfolio needs. But if you are willing to take more risk or more return, then you can also consider a mid cap fund of well. So I think a simple large and mid cap index fund is good enough for your portfolio over a very long time.
Right. That's quite helpful. So another follow-on question on the same kind of topic is, Like the viewer is a student and he has earned money via some tuition fees, and he's saying that can I actually do an SIP in index funds or ETF? Will that be safe for him being a very young age?
Yeah, so this is a very, very good question. Why I say that is because I always talk about and this is something which I talk about in my presentation, is the power of compounding. Power of compounding is I think Einstein or someone said that it's like the eighth wonder of the world, and I think the only way you can really take advantage of the power of compounding is by investing early. So I get a lot of questions from students, about when should I invest? Should I invest now? Should I invest, after I get married, after buy my kids or a house? So I think the easy answer to that is to invest right now. As soon as possible. The money that invest today, will double, triple in value over the next 10 to 15 years time. So there's a very popular example of live example of the world's most popular investor, who's Warren Buffett. He started investing at age 11, and I think I read somewhere that 62 out of the 65 billion that he's valued today has come after the age of I would say 70 or something. So so very important. The first billion dollars took him maybe roughly 50, 60 years, and sort of subsequently, he could compound his wealth at a much higher rate. So very important. The earlier you invest, the better it is. The more time you're putting in for your money to compound over the long term, and the better your returns will be. So an SIP strategy as a student is excellent. I really recommend it. I tell everyone, when it comes to investing, it's not about investing right, it's about investing early, and giving it time. I think those two things are very important.
Right. This is helpful, Pratik. So, according to you, what are the future drivers for the growth of passive funds, according to you?
Yeah, I think in terms of future drivers, fairly, what I spoke about in my presentation. So, I would say, future drivers would be, more education. I think this generation is able to, Google stuff out, so, and so their ability to self-learn and know about more and more products and more and more styles of investing is going to help in a very big way. So I think, my view would be that there's a whole new generation of do-it-yourself investors, who really like passive funds. They're very simple, and that will be a big driver. The second, as I said, is people are becoming a lot more cost conscious about how much they pay for mutual funds, and also people want something simple. I think a combination, because and what we've seen is the return of passive funds are pretty much the same, at least on most categories. So I think those are 3-4 reasons to why I think they will do really well in the future.
Right, right. The next question actually is, since last 6 months, a lot of AMCs have launched global equity funds. Is there any other reason apart from the diversification? I think you touch upon this topic in brief, but maybe if you could just reiterate the same thing.
Yeah, I think in my view, and this is being consistent, is I think diversification is the best reason. I would say people are investing for 2 reasons abroad. One is diversification, and the other one is they're looking to increase their returns. The US especially has done really well in the last 10 years, and people have this FOMO or fear of missing out. Because of that, people are investing heavily in the US. I believe that that's not really good reason. If you look at the last 20 years, India has actually done better than the US. So I believe the main reason should be diversification. I think that's a more sustainable reason. You should look at it from lowering the volatility of your portfolio. There's so many funds out there. I think stick to a very simple, broad-based fund. There will be a lot more themes coming in, but just be wary, because what at least my experience has seen, and I used to be a wealth manager, is that when it comes to global investing, if there's any high volatile event, if it happens in India, it's fine because we understand the country. But if that high volatility event happens, say, in Japan or China or UK, or some small theme out there, then it's very difficult for us as investors to handle that volatility because we don't know a lot. So I would say when it comes to global investing, at least start off with something very simple, and then if you find a theme very attractive, then you could look into that as well.
Right. I think another follow-on question is basically, why not have a single global fund as against having multiple funds? What is the advantage of having multiple regional funds as against the single one fund which gives exposure to entire world?
Yeah, it's a great question. I think it makes life simple if you have a single fund which can invest in the entire world. I mean, the only problem is that you may have shifts in certain. I mean, number one, it's very difficult to manage a global fund, and also number two, I think when you look at, say, the US, which has been selling global funds for the last many decades. Global funds are not just as popular because people want to get access to certain geographies, and people like to invest in the US specifically and then look at the world. So having a global fund definitely makes life simple, but it's just not as popular a theme. People do want the option of investing, in multiple sort of geographies or multiple regions. Just for example, in India itself, I can say that people don't want to buy one mutual fund. They want to buy a large cap fund. They want to buy a mid cap fund. They want to buy a sector fund. The same way, even in global investing, what investors have shown that they want that choice to be able to play different markets differently.
Another question is basically the US has delivered stellar return over last decade. So is it like, does it make sense to look beyond US market?
Yeah, I definitely think so. I think if you're looking at, say, if you want simplicity, to be honest, a US fund is good enough. It's already very globally diversified. So I think investors who are asking that question, who want something simple, then a simple broad-based, US fund is good enough for your international. But if you are looking at opportunities outside US, and what we've seen is the US is only half the world. You also have the other half of the world where you have a lot of wealth creation opportunities. Then investors can look at non-US funds as well. So I would say that the first country should ideally be the US because it tends to be the biggest, tends to have the most globally diversified business models. And then as an add-on, you can look at adding a developed markets or an emerging market, or a certain theme that you like.
Right. Thanks. I think passive funds, one of the key attributes, low cost, and I think there are what is the different average expense ratio for different categories of passive fund? Any insights on that, Pratik?
I would say, I think in terms of expense ratio, I think it really depends on the fund house and the fund itself. So there is no, I would say, convention on how funds are priced. I would say if you're looking at a similar fund, say if you wanted to choose between two Nifty 50 funds or two mid cap funds, which are very similar in nature, I think you should go for the one which is not the lowest, but one of the lowest. I think we've also seen is that funds with the lowest expense ratio may not be the best funds. My belief is that comparing similar funds, you should ideally look for not look for one of the lowest cost funds, because that tends to be the most efficient. There's also a concept called tracking error, which really talks about how efficient the fund is in tracking the underlying index. So we all should know the fact that index funds do not give the same return as index. And there are certain transaction costs, and there are also certain expenses that the AMC has to charge the customer, and also they have to incur. So you'll always have a small difference between what the index makes versus what your fund makes. And I think a lower sort of expense ratio can minimize that. So I think that's what I would say when it comes to trying to sort of figure out the price of passive funds.
Right. In the interest of time, I think I'll take up one final question, which is basically there are so many funds tracking the same index. So what is the right criteria to choose a fund for a particular industry? Can you help investors understand that?
Yeah. So I think coming from my previous answer, I think if you're choosing between two similar, I would say funds, say today we have about 20 or 30 Nifty 50 index funds and ETFs. So it's I think 2 years back we had a problem of I think options. Now we have a problem of choice. And I would say investors should look at three things. One is what is the expense ratio? It should be one of the lowest out there. So not the lowest, but maybe 4 or 5 or 10.1% around the lowest one, which I think makes sense. The second is the size of the fund. What we've seen is that bigger funds tend to do slightly better in efficiency. So that's also one criteria that I would look at. And third is this concept, as I said, tracking error, which is available on fact sheets. So you can find that number. should be available on platforms on the AMC websites as well. So these three things is what I would say are important to look at when you're trying to choose between two the same sort of index funds.
So thanks, Pratik. But I just have one more question. There are continuously a lot of questions coming in, but one final question probably now this time is should investors just do passive funds, or they can consider like a combination of an active and passive?
Yeah. So it's a great question. I mean, to be honest, if you want to keep things very simple, then passive funds are good enough for your portfolio. But what most investors tend to do is to have a combination of active and passive. So there's a concept called core and satellite, which I never got to my presentation, where ideally when you're looking at say investing for say 10, 15, 20, maybe 30 years, if you're young, you could look at a passive portfolio, because you don't have to I think make a lot of changes to that. You don't have to worry about say bad performance. But if you want if investors are want to do diligence, and you want to go out there and find the right strategy, then investors can add an active fund to play on the next say 2 to 4 years time if they like a particular strategy. So I think yes, a combination of both is what most people end up doing. But also I would say that when you're trying to find an active strategy, don't go by performance alone. Performance rarely does past performance and future performance similar. So I would say maybe look at more things than just performance. Look at the underlying strategy, the fund house philosophy before you go out there and I think put your money to active funds. So I think very important. Performance is not as important as what people say. So.
Thank you so much, Pratik, for the insightful presentation and taking the lot of question answers. Over to you.
Right. Thanks, Mahavir. So just so that everyone knows, that was Mahavir Kaswa. So he's I think he's the head of research for the entire passive funds business. So like a lot of content and blogs and white papers that you guys read from us is coming from his team. So thank you, Mahavir. So we're moving on to our next speaker of the day. So extremely excited. I think for the next speaker. He's an ex-portfolio manager at Morgan Stanley, and is currently the founder and CEO of an investment platform called Kuvera, which I'm honestly a big fan of. I think he is a part of an extremely fast-growing startup in the fintech space, and is really being able to build an excellent platform for a huge number of people today in India who are looking at sort of DIY investing, which is do-it-yourself investing. So today we'll hear from Gaurav. He can help us understand passive investing from a lens of a fintech company, of at least an investment platform which is very popular amongst millennials and sort of the younger folks, and we'll be able to learn a lot from his experience so far. So over to you, Gaurav.
Thanks so much. First of all, thanks to Motilal Oswal and Pratik and Jatin for inviting us at this forum. I think we should have a lot more passive forums, and we should also have a lot more educational sessions so that people learn about passive investing. I'll also want to say that I'm glad I'm speaking after Pratik, because he's talked about a lot of concepts about on passive investing, on why it is cheaper, why on average the returns are better, and why investors should look at passive not just for domestic but also for global investing. So if you're watching this anytime in the future, make sure that you also watch Pratik's talk, because a lot of the concepts are similar, and believe me, we didn't discuss any of this before. So without further ado, I'm going to talk about passive investing in fintechs, and the way I'm structuring it is, if not us, who, and if not now, when. So is it the right time to think about passives, and will fintechs in one way or the other lead the charge towards passive investing? That's what I'm trying to kind of cover today. Yeah. Just a quick background on who we are. So I run Kuvera. Kuvera was the first free direct mutual fund investing platform. So we started back in 2017 when direct was still not as popular. We were probably the second or third direct plan investing platform, the first that got onto the BSE Star MF to allow investing into direct mutual funds. Since then, we have grown to about 1 million users now. We have 30,000 crores of asset under advice. about we process about 900 crores of mutual fund transactions every month, right? So we do understand a little bit about investor behavior. We do understand a little bit about what the young investors, what the new investors are looking for, what kind of solutions they're looking for. So I'm going to kind of also share some of that experience. Some of it is positive for passive, some of it is not as positive, but we can have a very fair discussion on that. And then if you have any questions, or if anyone has any questions, I'll be very happy to answer that, right? So coming into the big question, right? Is there anything about being a fintech that fintechs prefer passive funds ETFs? The question comes because of multiple reasons. I think globally, if you look at most fintechs, especially wealth techs, right? Starting from the wealth fronts all the way down to Moneybox in the UK, they tend to build their model portfolios around passive funds. They tend to promote low-cost passive investing. So is there something that kind of makes passive funds and ETFs preferable to fintechs like us, right? And we'll be looking at this from 4 different lenses, right? The first one is performance data. Are passives better for our users? Second is, where can we bring value to the table as an online platform, as a platform that is providing investment tools to our end users? Where is it that we bring the disproportionate value, right? Third is incentives. Is passive actually better for fintechs? And this is where we'll find out that not all fintechs adapt to passives equally quickly. And finally, how big is the opportunity, right? Like, where is the opportunity set for in passive funds for fintechs? And how do we believe that different fintechs, different wealth techs will play the passive opportunity in the next 2-3 years? Some of it has already started. We can discuss examples, but these are the 4 big points that I'm trying to cover today. Performance data, what's better for our users? So like I said, Pratik did cover this. There is, I think there's immense data right now that, I mean, I don't want to actually post the data, but doesn't matter which country you look at. It's almost a given that across all market geographies, across all markets, whether it be emerging, whether it be developed, the average active fund finds it very hard to outperform a passive fund, right? In India, in large caps, over the last 10 years, this number can be as high as a 65-70%. So about 70% of active funds have underperformed the Nifty 50 or a Nifty 100 benchmark in the last 10 years, right? On top of that, the average active fund is more expensive than a passive fund. You can get a Nifty 50 fund for anywhere from 10 to 20 basis points. Even if you look at a Nifty Next 50, or if you look at a mid cap index or a small cap index, pretty much everything in a direct plan is available at 30 to 40 basis points range, while active funds in the same dimensions can go anywhere as high as 1.5%, right? So in a way, you can say that active funds is a place where you pay to kind of underperform. I mean, it's not exactly true. You pay because you want to outperform, but at least as the way the data has fallen out over the last, actually a century of data in the US, almost 40 to 50 years in Europe, and 30 years in India, is that passive is a safer choice if you want to outperform over the long term. In 3 to 5 year period, anything can happen. But if you want to outperform over the long term, passive is a safer choice, and you pay a lower expense ratio, so you save on cost. So from our perspective, from the user's perspective, from the end user's perspective, as a fiduciary, we are an RIA. We should vote passive because it makes all the sense, right? Second is, where can we add value, right? As an online platform, we can provide a lot of tools to our end users. We can provide them with a lot of different ways to look at their portfolio, to look at their risks, and to be able to manage that risk over the life cycle of that investment, right? Now, there are 2 ways we can do that. One way to add value is that we can say, hey, you know what, we are really good at timing fund manager performance. And honestly, if you are really good at timing fund manager performance, then active will make sense, because in any given 3 to 5 year period, there will be a bunch of active funds that will outperform the index. It's just that as that time period keeps on increasing, that percentage keeps on falling, right? So, but in reality, what happens is that fund manager performance, timing it is incredibly hard. People have spent billions and billions of dollars trying to figure out, are there signals, are there different ways in which you can time a fund manager performance for an active fund, and mostly they have failed, right? Even if something works for 5 to 6 years, doesn't work for any sustainable period of time. So why does manager performance, timing manager performance fail? Multiple reasons. Factor timing itself is hard. There is style drift. A manager might start out as a pure value manager, but then kind of start getting into growth if growth funds do well. There's manager rotation. What do you do when the manager leaves? There is closeted indexing. There's tons and tons of issues, all very well documented. On the other side is what also Pratik spoke about. We believe we can add value via passive asset allocation. Now, asset allocation, it's a simpler, more tractable way of saying that, through rebalancing alpha, through kind of advising the end users to be well diversified, through optimizing their taxes, and through reducing their expense ratios, we can add alpha at the portfolio level. We're not trying to add alpha at the fund level, right? The passive funds, by definition, won't have alpha, but at a portfolio level, you can add that alpha through rebalancing, diversification, tax optimization, and lower expense. So our strong belief is that for a robo-advisory model, or for a platform like ours that is providing all these tools to our end user, if we have a goal planning coupled with passive asset allocation, then we can drive more effective outcomes for our end users in terms of their retirement wealth, in terms of how much money they have for future healthcare, so on and so forth. So the third one, which is actually the key in every debate, is what is better for us as a fintech. What is better for us? Is passive better for us, or is active better for us, right? And incentives, incentives is like the two quotes that come to mind. One is Mind's law: where you stand depends on where you sit. And the second one, which happens to be my favorite: it is difficult to get a man to understand something when his salary depends upon his not understanding it, right? So incentives usually decide which wealth techs adapt or adopt passive more vociferously and more openly, versus which continue to push for active through different kind of storytelling. I mean, if you can't use data, you can always use stories, right? You can always kind of build something to promote active investing, right? And the differentiation is clear. I think everyone here knows this. If it's a direct mutual fund platform, you're not getting any commissions from the AMC. Your end users are paying you. If you're a regular mutual fund platform, you earn a commission. And it so happens that active funds have a commissions which are 4 to 5 times higher than passive funds. So it's very hard if you look at from a pure incentive perspective. I'm not saying that incentive is everything. A regular mutual fund platform will also say that they want to do the best for their end users, because at the end of the day, if the user wins, you win. But in balance, their incentives are more aligned to active funds. So they will not adopt passive as vocally as a direct mutual fund platform. And we see that in practice as well. I mean, the names. I'm not going to name names here, but the names, and we see this exactly. We see this in practice. The final question is, how big is the opportunity? The opportunity, we believe, in passive is massive, right? India currently is at an asset split which is similar to the US in late 2000s, roughly about 20% or so of passives. About 20% of all assets are passive, out of which I think retail is much smaller. So the one differentiation between the US data is that retail passive participation in India is probably closer to the 98 2000 level, probably sub 5% right now. But if the US market is any indication, right, and even if you look at the US market, the real growth in passive happened after the 2008 financial crisis. It was a crisis that people don't know exactly what happened. There was a crisis, a bunch of fintech platforms launched in the US. There was Wealthfront, there was a Betterment, and it kind of coincides really well with how passives took over, and now they are at parity in the US. Something similar is going to happen in India. Our strong belief is that something similar will happen in India, and passive can be a path. And this is where I think the debate thickens, and the arguments and the counter arguments thicken that. But we do believe that passives can be a path for a lot of fintechs to try and become an asset manager. It's already started happening. I think likes of Zerodha and Grow and a bunch of online platforms, investment platforms have applied for an AMC license. And I would be very surprised if they launch anything except a passive only asset manager, right? And what they are looking at, and what they are looking at, is to try and capture this wave. So the best case scenario as a platform for us is that assets under management rise. So overall, the sum of assets plus passive rises, and passive share increases, wherein at least some wealth tech platforms will try and monetize by becoming asset managers, because in a direct plan platform, they may not be able to monetize it through any other channel. So our choice has been clear. About 60% of our model portfolio allocation has been in passives, and this has been true since launch. This is in 2017. We have also made discovery of passives easier. So, on our dashboard, you will see explore index funds. We want more people to find out about index funds, learn about index funds, at least see that there is a huge selection of index funds that is available today. So how are we doing, right? All of this, having a strong pro-passive kind of tilt and kind of making the discovery easier. Still, if we look at our own platform, only 1 in 5 most purchased fund on Kuvera is a passive fund. It's good, but it's not like, it's not like, oh, you tell people these are the benefits of passive. You might think, oh my God, these arguments are like undeniable. You should invest in passive, but habits take time to change. Investment habits take time to change. Investment stories, investment theories take time to change, right? So today we are at 1 in 5. I would say we are doing okay. I won't say that we are doing great, but that's also the opportunity we have. So what gives, right? And this is kind of what I alluded to earlier. This is kind of what I think Pratik also mentioned in passing. If we look at the most watchlisted fund on Kuvera, there is almost a 65% correlation to the past 1 year, 3 year performance, right? So effectively, people are watchlisting funds that have done well in the past 1 year or 3 year. And this is true across wealth brackets. So this thought that wealthier investors are somehow more savvier does not reflect in the data, right? Even for the wealthiest user, that correlation holds true. And if you look at the past 1 year, 3 year performance, which funds will do the best? It will always be active funds, right? Because by definition, your passive fund is somewhere in the average. There are funds above, there are funds below. It's just that the funds that are above the average keep on switching every year or every 3 years or 5 years, and passive wins on consistency. So on a 10-year basis, passive funds look phenomenal, but on a 1 year, 3 year basis, they will rarely be in the highest performing funds, right? So that's the challenge that we are trying to solve for, and we believe that's a challenge that we are trying to solve for. And I just wanted to kind of show some more data that we did this study where we wanted to see that do past returns actually predict any future outperformance. So we looked at we looked at the past 5 year best performing funds, and then looked at their next 1 year of performance, right? So we look at a look back period of 5 years. We select the best performing funds, the top 10%. Then we see where do they fall in the next 1 year. It's all over the place. There is actually zero predictability on past performance, but that's what investors keep on doing all the time. This is the biggest fundamental behavioral issue that has to be in some sense overcome, either through storytelling or through data, for people to actually take on to passive, right? So, so effectively, where are we, right? So from what I've been kind of, if you follow the entire thought process, our belief is that passive needs investor education at scale, and AMCs have to play a big role in this. What AMCs have done a great job. I mean, I'm talking from this purely from a perspective of a fintech, right? And also as an investor, my entire portfolio is passive, by the way. What AMCs have done a very good job of is they've added a lot of passive choices. What they've not done so well is they're not endorsing passives even though a lot of their own data, even though a lot of their own analysis might suggest passive is better. And this could be because there is an incentive gridlock within the AMCs as well. There is an existing business, there are fund managers, there is a distribution business, and it's hard. So effectively, that is also, this second part is also opening up an opportunity for some of the fintechs or wealth techs to say that, hey, can we come in? Can we shake the status quo? Because we don't have fund managers, we don't have distributors, and can we own the passive story? So the big thought process as a fintech that we think of is, I think passive is here to stay, passive is going to grow. These are some of the things we all agree. The big question that I think everyone is now really debating is who is going to own the passive story, and what will be required to be able to own this passive story. I'll stop here, and if there are any questions, if there's anything I can answer, really happy to.
Great. Thanks, Gaurav. That was extremely informative and excellent insights from the lens of you and Kuvera. So we'll now move on to some Q&As which we've got from a YouTube channel. But before that, I just wanted to ask a question myself about what change you've seen over the last at least 3 years. So I can give you some context here. So when we launched our first, I would say, four or five funds, we had virtually no demand for them, and it was tough. And I went to a lot of wealth houses, a lot of I would say distributors, a lot of brokerage houses, but there just wasn't really demand. There wasn't as much education out there. In fact, the first I would say intermediaries who really picked up passive products were actually fintech platforms. Such as yours. So the whole reason to why at least I'm here is a large deal because of platforms like yours who have given a lot of education and advice to a lot of investors on passive investing. But compared to where things were about 3 years back, what have you seen in terms of shift from your customers who've been around for the last 3 or 4 years time? Any insights that you could give us from how their behavior has changed?
Sure. See, 2017, when we first launched, when we first disclosed our first model portfolio, right? The biggest pushback was, why do you want us to invest in Nifty 50 and Nifty Next 50, right? The biggest pushback literally was indexing works in the US, India is not the US, emerging markets are different. This time, all the arguments that you hear about, indexing all the time, and people found it very hard to kind of appreciate that. The logic of why passives actually work over long durations, right? Even in our own data, right? I mean, we have 1 in 5 most bought fund is passive today. This has been true for about the past 1.5, 2 years. For the first 1 year, I think that the passive fund would have been in that, if I look at the top most bought funds month after month after month, the first passive fund would feature in the 11th or 12th position. So there has been a change. There has been a acceptance of passive. But I'll give a small caveat here, right? I'm not 100% sure that this acceptance of passive has happened because people are understanding the passive philosophy. Some of it has also happened because some very popular funds underperformed Nifty 50, and index itself did much better in the last 3 years. The Nifty 50 and the Nifty Next 50 has done, and I think some of that is being reflected in people saying that, oh, okay, you know what, actually index returns are not that bad. So we'll have to wait till a complete business cycle to kind of, come to a conclusion that, what, people are actually understanding passives in the way they should, like a, diversified asset allocation model, like you also mentioned, and they're investing in passives for the right reasons.
Got it. Great. So we have some questions from our audience. I start off with saying, I think, what you spoke about earlier is that, I think the last 3 years, the Nifty and Next 50 has done really well. But some people are asking, is that trend expected to reverse over the next 3 or 4 years time?
It's a fantastic question. And the question you have to ask is not that how Nifty 50 and Nifty Next 50 have done. The question that you have to ask is very different. Today, can you identify the manager that will sustainably outperform Nifty Next 50 in the next 4 years? There will always be a fund manager that will outperform the index. the right way to frame that question. Because if someone comes to you and says, hey, you know what, in the next 4 years, I think three large cap funds will outperform Nifty 50. I'll say, yes, they will. But can you tell me today which those 3 funds will be? And because you cannot say which those 3 funds will be with any level of surety, index still is your highest expected return option. Unless you're open to taking the risk of underperformance.
Got it. No, great. So the next question is to do with Kuvera. So so someone's asking, how would ideally rebalancing work on your platform, and what are the different types of rebalancing that people could do?
So we follow more of a goal-based approach. So we have an end-to-end goal-based solution where if you enter your goals, then we have this goal planning tool, which will kind of tell you what kind of asset allocation you should have. And if your asset allocation moves by more than 5% from where our model asset allocation is, we send you a notification. And the notification is basically along the lines that, hey, you know what, we don't have any power of attorney on anyone's assets, so we cannot auto rebalance anything. But our tool can help you send the right triggers at the right time. That, hey, you know what, at least compared to our model allocation, you're 5% off, and you should try and rebalance from either equity to debt or from debt to equity. The most interesting thing is that a lot of investors who have been with us, they find out that a lot of the model recommendations are actually very counterintuitive. They make perfect sense in the long run, right? But at the point in time, they're very counterintuitive. So last March, we are telling them sell debt and buy equity, while your own behavior would be. And just the fact that we send a message like that, even if someone does not implement it, a lot of times people come back and say that, hey, you know what, because you send me that you send me that nudge, at least I didn't sell my equity. At least I didn't de-risk any further. Maybe they didn't sell their debt and buy equity, which would have been the right thing to do, but at least they didn't sell more equity and kind of they went more into the hole as well, right? So it's always and completely goal-based, because we find it very hard to be able to kind of think of any kind of an asset allocation without knowing what kind of purpose that money will be used for.
Got it. Great. So I'm getting a question. Do you have so there's someone in the audience who's 65, retired, and suppose they want to go to Kuvera and start their investing. What would you recommend them to do? Do you have a lot of users who are of that age group? And if you have, what do they end up doing, and what would you recommend?
Great. So unfortunately, we don't have a lot of users who are 50 plus, to be very honest. And I think this I can say with enough confidence is true for most wealth tech platforms. We do have quite a bit accounts which belong to elderly people, but they're usually managed by the kids. So they're managed accounts, right? 65. See, the thing is, right, once you're in the 60 to 70 age bracket, it becomes a little tricky, because what we don't know and what we as a wealth tech platform have difficulty finding out is, are you investing this because you need money for your remaining retirement years? Or are you investing this so that this corpus increases as a bequeathment to your kids? At that age, wealth level becomes very, very important. I'll give you a very simple example, right? If you are really, really well off, then there is no reason for you to become extra conservative at 65. In fact, you should now start investing based on your kids' life goals. Because a big percentage of that money is going to go to your kids. So for you to go into all debt thinking, because 100 minus 65 or whatever that asset allocation model, back of the envelope asset allocation, it's going to give you a mathematically correct answer, but it's not intuitive for the level of your wealth. So that's the population where we find it very hard. I mean, if someone emails us, we kind of give them the context that if you think you have enough saved for retirement, then you can take more risk. There is no reason just because you're 65, you can't take more risk. In fact, post 65, if you're wealthy, your risk should go up. But if you are kind of saving for yourself, then you of course have to be more conservative.
Got it. So last question for today. Before we wrap up your session, in terms of your platform, obviously most of the action today happens in the Nifty 50 and sort of next 50 type of funds. But what are you seeing about users adopting other funds across categories, say it's sector or mid cap, small cap, or international? Any insights out there?
So where we see the most traction is large cap, mid cap, small cap index funds, like you rightly said, and international funds. So in international also, I think within India, where we see most traction in index is S&P 500 and NASDAQ. People understand US. We use a lot of that technology. We use a lot of those products. Even though they are not Indian companies, they almost, the home bias applies because you're using the products day in and day out. Outside of these two, we find very little demand for index funds.
Got it.
That's where the meat is. Yeah.
Got it. Great. Thanks so much, Gaurav. This has been great. Thank you for your insights, and obviously, looking forward to more of these in the future as well.
Thanks, Pratik. Thanks for having me here. Bye.
Thanks. Bye. So that was Gaurav Rastogi of Kuvera. So without ado, we can move on to our next speaker today. He is coming in from the States. So good morning, Tim. Good to see you out here in the morning, and looking forward to having a great discussion with you, on passive funds. Just as a brief introduction, Tim is the managing director of the investment strategy for S&P Dow Jones Indices, and has garnered years of experience in index-based investing, especially when it comes to making indexes. Just to give the audience a brief idea, us as a mutual fund company, we don't do a lot of analytics on how an index is constructed and what should go in, what should go out. That is all decided by the index company. So in India, I'm sure a lot of you would have heard of Nifty. When it comes to international indexes, I think S&P Dow Jones is probably one of the biggest and most popular ones out there. We also have an S&P 500 fund, which is extremely popular with all our investors. So that's basically why index providers are equally, if not more important, to our investor base than us as an asset manager. So today, Tim will be helping us understand how one can go international with I think passive funds, the ease of use of international investing, and and what sort of innovation is the team at S&P Dow Jones are working on in terms of future products. So thank you so much. Over to you, Tim. Thank you.
Thank you very much for that warm introduction, Pratik, and thank you to the organisers for inviting me to participate. I'm delighted to be joining you, and a very good afternoon, evening to those who've joined around the world, but of course, especially in India. So now comes what I hope will be the only difficult part of the presentation, when I try and share my screen and we see whether or not that works. So fingers crossed, everyone. Are we in? Excellent. I hope you can all now see this. So international investing the passive way. And so I'll be talking for about 20 minutes on really the core ideas and benefits of international investing in a passive framework. And I really want to strip it back down to the basics. And if I don't answer these questions successfully in the next 20 minutes or so, please be reassured that there will be time for Q&A. But when you think of the notion of investing abroad in the equity markets, you've got some really basic questions that you're going to start with. So first of all, what? The international equity markets are a big and wide world. So which markets should you invest in? What are the thoughts that might be in your mind as you think about which exposures are going to be complementary? Why? What is the point? What are you hoping to achieve? And we'll talk a very little bit about why that might be different for investors in India than it is for investors elsewhere. How? Should you be looking for an active and dynamic allocation, or as the title of my talk suggests, is it perhaps very useful to think about a passive core building block to international diversification as perhaps the first step, or as perhaps the last and the most strategic step? And finally, when should you be timing the market, or when is international diversification going to be a help, and when is it going to be a hindrance? And I will talk a little bit about all of these questions, but one of them I can at least give you a broad idea before we even start. So when? And note the key here is that word diversification. The idea of a diversified portfolio, or the benefit of a diversified portfolio, is that you will have a broad range of different performing assets, some of whom will do well some of the time. And what you hope is that when parts of your portfolio are doing very badly, other parts of your portfolio will be leading up and helping manage those drawdowns. So if you have a so-called diversified portfolio and everything in your portfolio is doing really well, you may not be that diversified. The point about diversification is essentially you can sort of flip it on your head. Yeah, there's always going to be something doing well, or you hope there'll be always be doing something well. But as a natural consequence, there's always going to be a part of your portfolio that isn't doing so well. i.e., if there isn't a little bit of pain somewhere in your portfolio, you're probably not sufficiently diversified. The when of diversification, at least in sort of principle, is always. So with those motivating ideas finished, we'll go on to, I think, and we do need to address this question, because the Indian economy has shown over the past 20, 30 years even, one of the fastest growth rates of any global market. I personally am very sympathetic to the idea of backing India to grow and adopt its proper place on the world stage. And this is and much of what I will show you today is based on a research paper that we published last year. I'll give you another reference to that at the end. A lot of the data will be up to that point last year when we published that paper. As of June of last year, you can see here, so this is in red, the performance of the S&P India BMI, a broad-based equity index for the Indian market, compared to the roughly 50 different countries that are also represented in our global BMI. The performance here and just about everywhere in my presentation will be reported in Indian rupees. And just looking at this chart, you might well ask, why would I want to diversify? India is the best performing country over the last 20 odd years. And there's good reason to suppose that India might be one of the best performing countries in the near term future. So what's the point? Why would anyone consider diversification? Well, and here I'm going to switch to the Sensex, the S&P BSE Sensex, to give it its full name. The reason I do that is because it is one of the oldest major benchmarks in the world. So the Sensex has a really rich history that we can use for study and examination. And here what I'm showing you is, although you have that fantastic long-term performance, along the way, there have been plenty of difficult and challenging times. Drawdowns of 30, 40, even 50% occurring on a semi-regular basis. And as investors, these are the hardest times. With hindsight, we often know that those large drawdowns are exactly the time when you shouldn't be leading the market. And yet, as investors, it's very difficult to stay the course. And one of the most powerful things that a financial intermediary, wealth manager, for example, can do is to help clients to stay the course in those times of drawdown. And the most helpful thing to help people stay the course is quite literally to limit those drawdowns. And so you really want parts of the portfolio to zig as the core zags, meaning that you can preserve your capital better in those times of hardship. Now, how does this relate to international equities? Well, just to give you, a big picture idea, here's looking at the Sensex, again, which has one of the longest histories. versus the S&P 500, which has a live track record that stretches back to 1957. And on the left-hand side of what you can see, I wanted to just kind of illustrate these periods when one is leading or the other is leading. And you have these sort of long 6-7 year periods, a couple of short periods where one market is doing much better than the other. On the right-hand side, I just calculated, this shows you a ratio of the two indices. So when on the right-hand side, when that chart is going up, that means the Sensex is beating the 500. And when the chart is going down, it means the 500 is beating the Sensex. And what you can see is a strong sense of different returns. Sometimes one does well, sometimes the other does well. So this is very interesting from a diversification perspective. It suggests that there is a strong value in owning the pair of those indices over the market cycle. So in order to sort of take that concept and show you how that might have worked in theory historically, and again, we do have this long history for the Sensex and the S&P 500 that we can use. So this is just looking at a hypothetical 50-50 split between the S&P 500 and the BSE Sensex, again, all in Indian rupees, and looking at a quarterly rebalance back to 50-50. And you can see the power of that diversification coming through in returns. Now, and I should stress, this is unusual. This is not something you often get. This is a really complementary pair. And what's unusual is the combination portfolio actually outperformed, did better than either one of the individual pieces. Now, how's that happened? In part, it's because of that rebalancing, but it's the combination of that rebalancing and the fact that the combination of the two meant you preserved more capital in those drawdowns, which gave you a higher base from which to participate in the subsequent growth. Now, of course, diversification can help return. The real fundamental piece is about managing risk. And there's lots of different ways we can measure risk, sorry. Just the most common one is just measuring the volatility. And here you can see in yellow, the trailing 5-year volatility of the Sensex, in light blue, the S&P 500, and in that dotted line, the combination portfolio. And you can really see how even a 50-50 combination, because of those complementary diversification effects, has dragged down the volatility of the Sensex almost all the way down to where the very large cap S&P 500 is based. The power of portfolio diversification is one of the major tools available to portfolio management. And I don't want to spend too much time on this, but I just wanted to give you an idea. There's obviously a broader context. You have the Sensex, the S&P 500, you might have gold, you might have fixed income, and adding US equities can be a real power tool to give you a wider and broader range of risk return potential. Now we will come back to the S&P 500, but I wanted to just to give you one other perspective. So this is kind of a country-based, think about the US. When you're thinking about diversification, one of the things you want is complementary portfolios, different portfolios. One great way to look at this is from a sectoral perspective. So here you have the sector weight of the Sensex, which is pretty representative of the Indian equity market, the S&P 500, and the global BMI. And what I've done is I've actually ordered this table to show you where the big differences are. And on the right-hand side, you have the difference between the global or US markets versus the Indian markets. And I wanted to highlight a few things. First of all, the Indian markets are heavy or somewhat heavier in the energy, financials, and staples sector down the bottom. And some of the pieces that they're lacking in terms of what's the global opportunity set, healthcare, industrials, and consumer discretionary. So that international allocation can actually give you access to the returns of economic segments that are underrepresented in India, healthcare in particular being one that has obviously been in the news a lot over the last year. I also use this slide just to illustrate that actually the S&P 500 itself can be an efficient tool to access those global sectors. As one of the other speakers mentioned, the US equity market has some really global names in it, like in the healthcare, for example, Pfizer, Moderna. These are global names, not so much as US names. And the sectoral perspective can be really powerful because of how differently sectors behave. So this is picking, one of the evil things that presenters can do is pick their time period carefully. I showed you at the beginning a 20-year period where India did very well. In this one, I've picked a 10-year period where India didn't do quite so well, certainly compared to global sectors. And notice what India is hewing close to in here: financials, energy, materials. Those were the sectors that India had large representations in. The ones that it was missing, things like discretionary, healthcare in particular, these were the ones that did very well over that 10-year period. It's giving you another perspective on how the drivers of returns could be complementary in global markets versus the Indian markets. All right, so that is a very short summary of the notion and idea of why and how the diversification can help and what can make it work. Now let's talk about the next question. This is the passive enclave. So if you're going to invest internationally, should you try and pick stocks? Well, you certainly can try, but let me just first tell you that picking outperforming stocks in most markets, but in the US equity market especially, is especially hard, or it certainly has been hard. And that's not just because it's a very efficient market, it's also because of the structure of the equity markets. So in order to produce this particular chart, what we did was we took every stock that was ever a member of the S&P 500 over a 20-year period, and we looked at those returns of those stocks, and here's the distribution. So going left to right on the chart, you've got around between 10 and 15% of stocks that were members of the S&P 500, and in 20 years went down from 50 to 100%. Right? It can't go down more than 100%, but they can go up a lot more than 100%. And what you see is this long right tail with a couple of stocks, between 5 and 10% of the sample that delivered a more than 1,000% return, more than 10x. Now, because of this right skew, you have a small selection of stocks that historically have actually driven up the index return. Notice where the median was. 50% of stocks were below that median. In fact, over 2/3 of stocks were below the average. The index captures a share in all the returns, including those absolute heroes on the right-hand tail. And because of those, it's very hard to pick outperforming stocks. And this is especially true of the US equity markets over the past 20 years or so. I actually anticipate this will be true of stocks in the future because of what I mentioned at first. They can go down up to 100%, but there's no limit to the upside. So there's the theory. What about the empirical results? Well, for 20 years now, S&P has been publishing what we call our SPIVA reports, S&P Index versus Active. And what they do, we do this for India as well, is we look per region, US, UK, India, etc. And we'll look at actively managed funds, and we'll look at the percentage of those that are beating an appropriate S&P benchmark. So for example, in the US, it's the S&P 500. In India, it's the S&P BSE 100 for large cap funds. And what you see, so these are all the 10-year figures. The most recent ones are for the 10 years that ended in the summer of 2021. And you see around the world, generally speaking, a majority of actively managed funds underperformed, but I highlight in the US, you're looking at about 83% over the last 10 years. That's not an unusual figure. So empirically and theoretically, there's a very good argument for thinking of a passive approach to global diversification. And in the US markets in particular, as I said, it has been very hard to beat. So this is looking at the 1-year figures, year on year, 2001, 2002, and so on. What percentage of US-based large cap active funds managed to beat the S&P 500? Overall, most years, you're looking at a majority of funds underperforming. But notice since 2009, there hasn't been a single year when the average fund, when the median fund has outperformed. And I don't have an awful lot of time left, but I do want to just talk a little bit about really why that's going on. We talked about the skew, but there's also market structures here. So S&P 500 launched in 1957. In the mid-60s, you have some statistics here that shows about the professionalization of that market compared to roughly where they are today. So, you're going from 3 million shares trading a day on the NYSE, New York Stock Exchange, to around 1.5 billion shares. And that's statistically 2018. How many securities analysts are there? People with the job of identifying mispricings. That's kind of it's a newer career. There are up to 300 per broker, and there's a lot of brokers in the US today. There were very few back in the 1960s. The CFA, Chartered Financial Analysts, it was introduced in the early 70s. There were none in the when the S&P 500 launched. There are something like 150,000 CFAs today, another 250,000 taking exams. And then, very quickly to summarize, Bloomberg terminals have gone from 0 to over 300,000. The notion of a professional investor, there was only about 5,000, something like that, professional investors in the 1960s. I believe there is over 1 million people worldwide engaged in professional investing. Hedge funds, smartest money in the room, gone from very, very small proportion of the markets to around 4 trillion. ETFs, now this is really important. As investors turn to passive, what's been happening is, look, if I want to be above average, I need someone else to be below average. I need a net supply of my outperformance. And what's been happening in India and even longer in the US is those undiversified amateurs, those investors who maybe aren't smarter than the hedge funds, who've been a source of outperformance to those hedge funds, they've been disappointed with their performance, and many of them have been moving to index funds, and they've been getting the average, and they have not been supplying alpha to those who want to beat the average. Now, the US market has professionalized an incredible amount over the last 50 years or so, 60 years. But what is fascinating is to see this professionalization extend and develop in other markets around the world. I think the Indian market is one in particular, which is going through a rapid pace of professionalization. And I think some of the themes and challenges about performance that we see today in the US are being exported around the world as efficiency improves and the market gets harder and harder to beat. All right, so that kind of covers some of the ideas of why you might want to be passive. What difference does this all make to a portfolio? And this, again, is coming from that research we published last year. Just wanted to give you an idea of context. I hope you can see the right-hand side of this. If you can't, maybe move the video. But just to put it in context, right? So using our India SPIVA data, what's the difference between a top quartile Indian fund, active equity fund, and a bottom quartile over the last 10 years? 3% per annum. All right, so that's the difference. That's the value of picking a good fund, if you like, over a bad fund. 3% per annum. What's the difference? On average, based on a sort of standard deviation between gold, bonds, equities, or US equities overall. So thinking about that overall asset allocation, about 10%. Much more important decision. What about picking, say, healthcare versus information technology? I mentioned sector dispersion is very high. It makes a big difference. And here you see that on average, around 20% in return difference between information technology and sectors. That makes that an important decision. But right at the bottom, year on year, over the past 10 years, what was the difference in returns between the S&P 500 and the Sensex? An average of 26%. That is the power of that decision. Even a small allocation can make a really, really big difference. And I think that's one of the drivers behind the adoption that we've seen of passive, efficient ways to access international equities that has become such a strong theme within the Indian markets. I know I'm short on time. I just want to say just very shortly why the S&P 500? Why not just any other index? And I don't, maybe we get to this on the Q&A, but just very briefly, Indian investors who are looking at an S&P 500 exposure in India are leveraging and participating in a pricing efficiency based on a global range of trading products. The S&P 500 is watched by professional investors, watched like a hawk, traded by futures and options and ETF investors all around the world. There's a whole ecosystem policing that index level and helping liquidity for, say, an Indian fund or an Indian ETF or a Japan and so on. They're all participating in a global trading ecosystem that can help pricing and make bid-offer spreads more efficient for that S&P 500 index in particular versus any other. So I just wanted to highlight that on the left. You just have a comparison between US ETFs. The average bid-offer spreads are lower on S&P 500 products. On the right, it's just I'm not going to spend time on it, just an idea to give all that ecosystem, options, futures, leveraged ETFs, and so on. There's a really wide pool. All right, so I promise not to take too long. Here is what I hope I might have convinced you or persuaded you of. Number one, look, the Indian domestic markets have been fantastic and may well continue to be so. But an allocation to international equities can offer diversification benefits that can help you stay the course when the Indian markets go through the periods of not doing so well. Liquid, widely known and efficient indices like the S&P 500 can be used to capture a significant proportion of that opportunity of diversification without the need to pay a high fee or try to outperform the market. And these are just some examples of the way that passive investments, index-based tools offer toolkits for quite sophisticated portfolio construction. And this empowers investors to really focus on the most important decisions. So if you found all this interesting, and we will get to the Q&A, just a very, very short plug. If you'd like to dig into the weeds on this, as I say, we published quite a meaty paper last year called From Zero to Hero, the Indian case for global equity diversification. Why from zero to hero? Because 5-6 years ago, international home bias was close to 100%, but that's changing. And one of the fastest growing areas is in this index-based approach to international diversification. If you want to dig into this more, I'd encourage you to check out the paper. And of course, there's lots more data, analysis and commentary, as well as our SPIVA reports available on our website, which is spdji.com. So with that, I'm slightly over time, but I hope you enjoyed it. And now I see the floor back to our host, Pratik, and hopefully we'll have some Q&A.
Sorry. So great. Thank you, Tim, for your insights. That was extremely informative, and I think we've all been, I think, reiterating the fact that the true nature of international investing is actually diversification. I think, as you said, and that remains to be, one of a lot of our investors that we have in our funds. The reasons to why they would, I think, put a part of their portfolio outside. So thank you so much, Tim, for the presentation. So now we'll just go on to a quick, Q&A round. We have a bunch of questions on a YouTube channel. I think the first question, comes, for you in terms of, from a global perspective, since you see things from a very sort of global perspective, what are the most popular strategies that you are seeing right now? Not in terms of what's the largest, but especially in the current times, what are you looking at it, or what are you seeing as an index provider? Some of the largest or most popular strategies for investors today.
Yeah. So look, if you look around the world, then I'll give you a sort of boring answer first, and then a slightly more interesting answer afterwards. Okay. So what are the most popular things? Where are the majority of the investments have come over time? They really are in these core building blocks, right? The countries, sectors, things like the S&P 500, where it's a bulk allocation to a whole market available at very low cost. These are by far the most popular overall, which I think is actually no surprise, right? Then more interestingly, where are we seeing new or developing interest? And where's the innovation, and which innovation are investors responding to most positively? And there, I'd say, if you look globally, one of the pieces of the puzzle that is just going through an absolute revolution in terms of investor interest is, if I say ESG investing, some people might not know what that means, but investing based on values as opposed to investing based on value. So looking at considerations like the environment, carbon emissions, or social goals like alleviating poverty, especially in Europe, but around the world. This is an absolute revolution with so much demand, so much interest, so much innovation. And speaking of innovation, that's perhaps just to add one or two additional thoughts. I think innovation is also something that there's a lot of interest in. The notion, particularly in markets where there's maybe not that bank of innovative companies that are part of the core of the equity market, looking for the next generation of, what in 10 years is going to be a major sector. And we don't know. It could be satellites. It could be any number of things. It could be decentralized finance. We don't know what it is. But gaining access to really innovative companies that are laying the grounds for the important segments of the economy in the future is something I think there's a lot of interest in globally, and especially in those markets where they maybe don't have a strong representation domestically from innovative firms. So that's a slightly longer answer than you wanted, but to shorten it, bulk beta, is really popular, always will be. A lot of innovation in ESG, and that notion of innovative companies, also something that I notice a global trend of interest.
Got it. Great. Just one last question before we wrap up. Very good question, actually. It says that, this could be relevant from sort of a multi-country analysis. Inefficient market passive funds are better suited for efficient markets, but not for inefficient markets. What is your take on that?
So I think there is, let me put it this way, a skilled active manager means something different in more efficient markets, right? So the question is, how difficult is it to beat the benchmark? And it typically and theoretically, it's easier to beat the benchmark in a more inefficient market. The challenge is, that's not what our data says. What our data shows you is that actually markets like emerging markets or more volatile or more risky or less efficient markets, although it's certainly true that there's more opportunity for outperformance. Trading costs are normally higher. Information is typically harder to get hold of. And the realization of skill is often much harder, and fees are much higher. So while sort of theoretically it's absolutely true, and I think the case is stronger for markets like the S&P 500, one challenge is that our SPIVA data suggests that actually it's not exactly what you expect, and actually outperformance in these inefficient markets is almost as hard. Certainly it's not true that it's easy to beat the market.
Great. Thank you, Tim, for your time and for the valuable insights. Hope to have you.
Thank you for having me.
Hope to have you again. Ladies and gentlemen, that was Mr. Tim Edwards from S&P Dow Jones. Thank you for your time, and looking forward to more events. Thank you. Great. So, moving on on our conclave today. So, I just wanted to remind all of you watching to post comments on our YouTube channel. I think we are taking questions from there, and please comment your questions, and hopefully we'll be able to answer them with our distinguished speakers today. So next up we have I would say one of the most experienced speakers on our today's speaker list. I think he was the president of Crystal for about 20 years, and he led their India research business. He's currently the CEO of Indices and Data at National Stock Exchange, which is NSE in long form. He's a highly revered professional, in the industry, and with a lot of experience and knowledge, under his sleeve. This is Mr. Mukesh Agarwal of NSE. He'll be helping us today understand some of the role that index providers, play in the area of passive investing. We believe that I think when you look at the king of, I would say, indices in India, it's very clearly Nifty. And to be honest, before even AMCs, spent money on education, I think it was NSE, which actually, did the hard leg up of, I think, educating a lot of people on what passive investing is, what index is. So I think kudos to the hard work done by, NSE and Mukesh and his team. And now obviously we have a very different market than what we had a few years ago. So over to you, Mukesh. Thank you for being here, and looking forward for your insights.
Thanks, Pratik. Just give me 1 second. Let me share my screen.
Sure.
Yeah. Can you see my screen now? Yeah.
Yes.
Thanks, Pratik, and good evening, my fellow speakers, ladies and gentlemen. Before I move forward, I would like to thank Motilal Oswal AMC for giving me this opportunity to speak at this conclave on passive investing. As Pratik mentioned earlier, we at NSE, we have been very passionate about this subject. We have been putting in a lot of efforts to see how the passive investing as a concept can pick up in India. And today we are very thrilled because the industry has really grown in leaps and bounds. And earlier in the conference, both Navin and Pratik have spoken about the numbers, the kind of growth we have seen in the industry. Just to recap, I think today the passive industry, the size of the passive industry in terms of INR, it is 4.25 lakh crores or 4.25 trillion Indian rupees. And the breakup of the same is, it is approximately 3.71 lakh crores is ETFs, and approximately 17,000, that's 3.71 I'm talking about is the debt and equity, and 17,000 crores rupees is the gold ETF, and around 36,500 is the index fund. So that is a broad breakup. And it has been most of the growth in, Pratik also spoke about it initially, most of the growth has happened in the last 5 years. Actually, the growth, if you look at the assets under management in ETFs, was something like 8,000, 9,000 crores at the end of March 2015. Last 5 years, the ETF industry has grown 17 times. So I think that is a stupendous growth. Now, today, the topic for my presentation is role of index providers in passive investing. So if you look at it, I would say that index providers and the mutual funds or the passive fund product manufacturers, we work very closely, because any new index idea to be created, we take feedback from them, we work with them, and then we try to create an index. And whenever we create an index, our main objective is the index should be representative of the market or the theme or the strategy on which the fund manager wants to launch the passive fund. And the second, which is the most important, that the index should be replicable also. No point in my having a stock in an index which the fund manager, which is trying to replicate the index in passive investment, is not able to replicate the index. So I think replicability and representativeness of the index of the market is very important. These are the two key features which we look at while creating the index. So I'll talk more about creation of the index when we move forward. So in my today's talk, I will talk about the variety of indices on which the ETFs and index funds are available in the country, because that has been growing leaps and bounds again. And why I'm saying that, because it is very important for all the investors to know that earlier when the whole thing started, the first ETF was launched on Nifty 50. But today, we as an investor, we have a wide choice and wide range of indices on which the ETFs and index funds are available. So if we have to do our asset allocation strategy, we want to follow thematic investment, we want to do strategy investments, we have the ETFs and index funds available. I will share some of the names with you. So that is the whole idea. Now, just to give you a quick recap, basically, if you look at it today, I have broken up my passive investments, as all of us know, comprises of two things. One is ETFs and second is the index funds. ETFs are traded on the stock exchanges, wherein the index funds you directly buy or sell from the mutual funds. I think that is the key difference. In both, the fund manager doesn't take any active call in buying the portfolio. They just replicate the index. They buy the constituents of the underlying index in the same weightage. Now, coming to ETFs, there are overall 103 ETFs available in the markets. And if you break it up into equity ETFs and debt ETFs, so within equity, we have around 88 ETFs listed and traded on the stock exchanges. And out of which 68 ETFs are linked to 24 Nifty indices. And 16 ETFs are benchmarked to 16 ETFs are benchmarked to 6 indices of Asia Index or BSE indices, and 4 ETFs are benchmarked to 4 global indices. And the total AUM of this 88 equity indices is around 3.16 lakh crores. And out of which 75% is benchmarked to Nifty indices. And within that, if you look at, almost 52% is benchmarked to Nifty 50. So Nifty 50 is the most popular index amongst the investors for the passive investments. And approximately 87,000 is benchmarked to BSE indices, and 6,700 crores is benchmarked to the foreign indices. Now, if you look at the debt ETFs, there are 15 debt ETFs which are listed and traded. And out of the 15, 14 are benchmarked to 11 Nifty indices. 1 is benchmarked to BSE index. And the total AUM of this 15 debt ETFs is approximately 46,000 crores. And the main ETF in this is Nifty Bharat Bond Index, which was launched in December 2019. I think Pratik did mention about debt indices or debt passive funds becoming popular in India, gaining popularity. Yes, I think after the launch of the Bharat Bond Index, the Bharat Bond ETF in December 19, which tracked the Nifty Bharat Bond Index series, the debt ETFs or index funds are really catching up. And then next is Nifty one-day rate index, which is around 3,800 crores, then Nifty SDL. So I think if you look at the Bharat Bond Index, why they are catching popularity, because if you look at Bharat Bond Index, the way it has been created, it is a target maturity index or target maturity ETF. What I mean by that, it means that the ETF or the index matures on a particular date, just like a FD would mature, a three-year FD or 5-year FD would mature on whatever XYZ date. Similarly, this ETFs and indices also mature on a particular date. So that is one. So what happens to, I think, because we believe that this gives 4 key, or this Bharat Bond ETFs or the way the passive funds have been created, these are 4 major advantages. One is the predictability of the cash flows is very high. So what I mean by that is, if you're investing on a particular date, you know what is my yield to maturity. And if you hold on to those ETFs or index funds till maturity, you are likely to get those kind of returns. So you know that what is the amount I'm expected to get and what is the date on which I will get the money. That is one. Second is the credit quality is very high, because all the indices what we have created so far are AAA or SDL, state development loans, or government securities. Second is they are liquid in the sense ETFs at least trade on the stock exchanges. You can buy and sell on the stock exchanges. Similarly, if you have invested in the index funds, you can redeem or buy directly from the mutual funds. And last is they are very tax efficient. So because if you are investing in a like-to-like comparison, if you invest in a bank FD, you have to pay tax at your applicable tax slab rate, wherein if you are buying a debt index fund or a debt ETF, and if you hold more than 3 years, then your tax rates are much lower at 20% after the indexation benefits. Just I wanted to highlight that. So now if you come to, this is an important slide again. Now, what are the top 10 indices in terms of ETF AUM? The top most index is Nifty 50, which has 17 ETFs tracking it, and the assets underlying this 17 ETFs is approximately 1.64 lakh crores. Next is S&P BSE Sensex, which is 79,000 crores. And you would also see that number 8, which is NASDAQ 100. So it's good to see that one foreign index is also gained popularity over here, which has got approximately 5,100 crores of assets. I think Pratik did mention about it. Navin also mentioned about it. The foreign the ETFs or index funds tracking the foreign indices are gaining popularity. They are getting AUM. And second thing is, in top 10, we have one international index and we have two debt indices. One is the Nifty Bharat Bond Index series, which has got an AUM of 36,000 crores. And we have Nifty One Day Rate Index, which has got 3,800 crores. So that is the thing. So as I mentioned earlier, overall, there are 46 indices in the country on which ETFs are available. But the top 10 indices which are shown over here, they account for 96% of the ETF AUM. And if you look at Nifty 50 alone, Nifty 50 accounts for 45% of the ETF AUM. And the largest debt ETF, as I mentioned earlier, tracks the Bharat Bond Index series. So this was on the ETFs. Now coming to index funds, in India, totally this data, whatever I'm talking about is as on September 30th, 2021. So we have around 53 index funds, out of which 48 are equity index funds and 5 are debt index funds. And out of this 48 index funds, 41 index funds are benchmarked to 11 indices or 11 Nifty indices, and 5 are benchmarked to BSE indices, and 2 index funds are benchmarked to 2 global indices. Now, if you look at in terms of AUM, approximately 22,500 crores is benchmarked to Nifty indices, 3,000 crores is benchmarked to BSE indices, and 2,300 crores is benchmarked to foreign indices. So overall, in terms of market share, it would be approximately 80% is benchmarked to both equity and debt put together, 80% is benchmarked to Nifty indices. Now coming to debt index funds, within debt index funds, we have 5 index funds totally, out of which 3 are benchmarked to Nifty indices and 2 are benchmarked to CRISIL indices. And the total AUM of these 5 debt index funds is 5,500 crores. Now here also, I just tried to project what are the top 10 indices in terms of index funds AUM. Here also Nifty 50 is the topmost, which is 17 funds and with an assets of 15,300 odd crores. Next is Nifty Next 50. Nifty Next 50 is an index which has been gaining popularity. We see a lot of new ETFs and index funds being launched. And we have, while we have 8 index funds over here, we have 7 ETFs tracking Nifty 50. So here also we have one international index, which is S&P 500. Tim also talked about, Pratik talked about it. So there is one index fund which is tracking S&P 500 and which has got garnered assets of around 2,100 and odd crores. So in index funds also, the top 10 indices account for approximately 92% of the AUM. And here also the story remains the same. Nifty 50 accounts for 47% of the AUM. Now this slide, I just quickly want to share how the number of indices on which ETFs and index funds are available in the country has been growing. So if you look at December end 2016, we had 48 ETFs available in the country and they were tracking 20 indices. Now, same thing if you look at as on September end 2021, so we have 103 ETFs tracking 46 indices. So over the last 5 years, almost 5 years, ETFs have been launched on approximately 26 new indices. And I will share some names with you as we move forward. Now coming to index funds as an end of 2016, we had 20 index funds tracking only 4 indices. Now same number if you look at as at end of September 2021, we have 53 index funds tracking 19 indices. So the fund managers, the AMCs are looking at launching ETFs and index funds on different indices, trying to give more options to the investors so that it can meet their investment requirement. This slide just talks about what are the indices on ETFs that have been launched in the last 3 years or last 2.5 years. So if you look at in the current financial year, which is April 21-22, starting from, FY 21-22, starting from April till September end, approximately 11 ETFs have been launched on 9 indices. Just imagine 11 ETFs on 9 different indices. So these indices are Nifty Consumption. So we have Nifty Consumption, Nifty Healthcare, Nifty Pharma. So we have this S&P 500, then NYSE FANG Plus, then Nifty AAA Bond Plus SDL. This is a debt ETF, Nifty FMCG, Nifty Financial Services, Nifty 5-year benchmark GSEC index. Again, this was again launched by Motilal, and even S&P 500 has been launched by Motilal. So similarly, if you look at last year in 2021, entire financial year, April to March, 16 ETFs were launched, and those are on 10 indices. So, and year before that, 11 ETFs were launched. So the number of ETFs being launched is also increasing, because this year, while the slide shows 11, but another 3 have been launched in October. So already 14 ETFs have been launched in the current financial year. So not only new ETFs are being launched, but also they are being launched on different kinds of indices. The story remains the same for index funds also. If you look at index funds in the current year, 9 index funds have been launched, and this 9 index funds have been launched on 7 different indices. And if you look at the last financial year, 10 index funds were launched, and all 10 index funds were launched on 10 different indices, which is again very heartening to see. And year before that, 9 index funds were launched. So this is showing that, and this year, like till September were 9, and in the month of October, we saw 4 index funds to be launched. So this year we have already seen 13 index funds being launched in the first 7 months, as against 10 index funds being launched in the entire financial year. Now, this slide just tries to show you that at NSE indices, we have 85 equity indices available in the market. We have the indices available in broad market category, which are representing different segments of the market, like Nifty 50, Nifty 100 is large cap. We have mid cap, we have 3, mid cap 50, mid cap 100, mid cap 150. Then we also have small cap 50, 100, 250. Then we have various sectoral indices. We have Nifty Auto, Nifty Bank, Nifty Financial Services. Financial Services is an index which Nifty Bank includes only banks, but Financial Services as an index includes banks, plus other financial services entities like housing finance companies, NBFCs, mutual funds, insurance companies. It gives a wider exposure to the segment. And we also have an index, we have also an ETF tracking this index. So next is thematic indices. We have 22. You have ESG indices over here, Nifty CPSC, Nifty Infrastructure, Services Sector, Consumption Theme, India Manufacturing. Then we also have strategy. Strategy, again, we have quality, value, then we have momentum, we have dividend. So you name it, and we have the index available. And good thing is, even if in strategy, if you look at, we have Nifty 50 equal weight on which ETF is available. We have Nifty 100 quality 30 on which ETF is available. Nifty dividend opportunities 50 on which ETF is available. Nifty 100 equal weight on which index funds or ETFs are available. Similarly, you have thematic indices on which index funds and ETFs are available. Similarly, in broad category, you have now, basically we have 3 broad categories: large cap, mid cap, and small cap. So you have index funds and ETFs available in all the 3 categories. In fact, Pratik was the first one who came and talked to us and said he wants to launch a index fund on Nifty 500. He launched an entire basket: small cap, mid cap, and Nifty 500. I think he wanted to be different. He wanted to make a different offering to his customers, and he did that. Now, similarly, in fixed income indices, we have 87 indices. I will not get more into details, but just the message we want to give over here is we have indices on different asset classes. Asset classes, I mean by corporate bonds, government securities or GSECs, then SDLs, trade development loans. We have on commercial papers, we have T-bills, treasury bills, certificate of deposits. And then here we also have fixed income aggregate indices, which is liquid, money market, ultra short, and then long duration, composite. So in this, if you look at it, we have ETFs or index funds available on Nifty 5-year benchmark GSEC, Nifty 10-year benchmark GSEC. And the next slide talks about the target maturity. Target maturity, we have 13 indices. And on each one of them, we have an index fund or ETF, which is available in the market. And we are continuously working on various different kinds of debt indices on which various mutual funds are looking at launching ETFs or index funds. Now, coming to index governance. Sorry, I'm running behind my schedule. So index governance, the comfort I want to give is the professional team at NSE Indices manages the construction and maintenance of indices under the close supervision and guidance of various index committees. We have 3 index committees. One is we have Equity Advisory Committee, we have Debt Advisory Committee, and they provide guidance on the macro issues related to equity and debt indices. Then we have Index Maintenance Subcommittee for equity, one for debt, and they look at and they are responsible. That committee is responsible for index methodology and they also approve the changes to the stock selection criteria and also what goes in and what goes out from the index. And last, we have Index Oversight Committee, which provides oversight to the administration of the indices, which being run by the NSE indices. Now, other thing which I want to give a comfort or mention over here is the criteria governing all Nifty indices, and typically that is followed by all the index companies globally, are publicly available in the methodology document, which is published on our NSE website and Nifty indices website. The methodology is so transparent, I would say that like people know that Nifty 50 or other indices go through a churn, or we do the rebalancing. We announce the rebalancing sometime in February and second rebalancing in August. So well before our announcement, there are, I would say, brokerages or sell side who start predicting or guessing what will go out and what will come in. So I think such is the transparency of the methodology we have available in the market. Now, compliances, coming to compliances. So basically we have ISCO principles for benchmarks, basically, which are available, prescribed by ISCO. Basically, the principles prescribes the expected level of industry best practices with an aim to bring transparency in benchmark determination process. So our Nifty indices are fully compliant with the ISCO principles, and we have also voluntarily decided to get an assessment done through an independent party. So Deloitte did it for us in 2016 and 2018, and EY did it for us in 2020. And this assessment reports are also available on our website. Now, there is a new requirement by European Union benchmark regulations have been published. We have UK benchmark regulations, basically for any index provider to offer indices in European Union. Our indices have to seek compliance through one of the options, which is equivalence, recognition, endorsement. So we are working on this, getting the compliance done by both UK benchmark regulators and EU benchmark regulators. And we expect our compliance process to be completed by December 2022, because this has to be, as per the regulation, this has to be completed by 1st January 2025. So, but we want to do it much before the time. Now, what are the new themes which we are working on? I think these are very, very exciting days, because we talk to so many different mutual funds and AMCs, and each one wants to launch an index fund or ETF on different theme. So we are working on very exciting themes. I would say we are working on defense, we are working on mobility, we are working on ESG. ESG, we already have 3 indices on which, in fact, all the active funds on ESG available in the country are benchmarked to our ESG indices. We also have one ESG ETF available in the market tracking our indices, but we are working on different concepts. We are working on non-cyclical consumption, and we are working on target maturity GSECs. We are working on housing theme. We are working on target maturity SDL. We are working on green. We are working on digital theme. We are working on GSEC for FPIs. In fact, this index we have already launched, and one of the AMCs has launched a product for FPIs in the international market. And we are also working on index on low carbon emissions. So what the message I want to give over here is we are working on different themes. And for investors, they will have a full bouquet of index funds or ETFs available on different kinds of index, depending on their asset allocation portfolio or asset allocation strategy. They can choose which index funds and which ETFs they want to invest in. So before I end, this is one of my favorite quotes by John Bogle. All of us know that John Bogle is the father of passive investing. He's the one who created this whole index funds. Where returns are concerned, time is your friend, but when costs are concerned, time is your enemy. I think we need to keep this in mind while taking our investment decision. Thank you very much.
Great. Thank you so much, Mukesh sir. A lot of insights, and we got to know a lot of future products that are coming in, from NSE. So due to the paucity of time, I just we had space for one question, which came from an audience member, who's actually confused. I think if you look at this state about 2 years ago, we had limited options when it comes to investors wanting to invest in index funds and ETFs. But today, I think the opposite has happened, where you have so many ETFs, so many index funds. I think they're close to 20 to 20 plus Nifty 50 index funds. So do you, as an index provider, as NSE, concerned about the number of funds, similar funds in the market, and about how the education for these funds happen through these multiple AMCs?
See, basically, to be honest, we as an index provider will not be worried about if more index funds are being launched, because see, today, if you look at it, Nifty 50 is the benchmark index of India. So no AMC would like to not have an index funds or ETF tracking Nifty 50. So today we have 17 ETFs tracking Nifty 50. We have 17 index funds tracking Nifty 50. So there will be more, might be coming. So I think for an investors, they have to look at the selection criteria. There are different selection criteria for choosing which index funds or ETFs to choose among the 17 index funds or 17 ETFs available. I think the topmost criteria is the tracking error. They have to choose, look at what is the index fund or the ETF which has got the least tracking error. And second, I would say, is the cost factor, because the expense ratios which the fund houses charge. So I think that is the one which they should look at. And third one is, if you're doing it ETFs, I think ETFs one is to look at the liquidity. What is the impact cost and what is the liquidity in terms of which we get to see from the bid and ask spread of the ETFs traded on the stock exchange. And based on this, they should decide which one to choose. So I don't think there's any question of confusion. More is there, but good thing is everyone says it's Nifty 50. So everyone knows that this index funds or ETF is investing in the Nifty 50 stocks which are part of Nifty 50. So that's from this idea.
Great. Thank you so much, sir. Thank you for your time, and we obviously look forward to having more sessions as these in the future. So, ladies and gentlemen, that was Mr. Mukesh Agarwal, CEO of Indices and Data at NSE, and thank you so much for your time.
Thank you very much. Thank you, everyone. Bye.
Great. So before we move on to the last speaker of the day, I just want to remind all of you out there on YouTube, to please comment, and also please post your comments, or please post your questions, and we'll get to that by the end of the presentation. So for now, I think let's move on to the speaker that I'm sure all of you have been eagerly waiting for. I'm personally a big fan. So this is a bit of a fan moment for me, and very rarely do I finish a book over a weekend. And I think The Psychology of Money was one of the books which I easily finished. I think over a weekend. It was a very having read a lot of investment books, I think it was probably one of the best ones I've read. And I sort of look forward for a lot of insights coming from our speaker. So he is the partner of the Collaborative Fund, a former columnist at the Motley Fool and at the Wall Street Journal. He's a two-time winner of the Best in Business Award from the Society of American Business Editors and Writers, and winner of New York Times Sydney Award. His latest project that is extremely popular today, I think is one of the best investment books out there, is a book called Psychology of Money. I think it's sold over 1 million copies so far. And without ado, I would like to introduce all of you to Morgan Housel. I think he'll be talking about dimensions of passive investing, a very interesting topic, and I hope all of you enjoy this talk. So with that, over to you, Morgan.
Well, thank you very much. Thank you for having me. It's an honor to be here. Good evening to you. Good morning from me. I'm coming at you from a hotel in Nashville, Tennessee right now. But thank you again for having me. I'm going to share my screen right now. I have some slides to share with you, so bear with me while I get this set up here. Let's see. Move this around. Here we go. There we are. Thank you. What I want to talk to you about today is the psychology of money. And I am mostly a passive investor. I have been for a long time. And so I'm happy to be here because I kind of feel like an outsider very often in the world of active investing. And what I want to talk to you about today and start with you today is a little bit of talk about investing history, particularly the question, why don't investors learn from it? Which is what we're doing. People invest in all over the world. With passive investors are making the same mistakes today that they were making 10, 20, 30, 50 years ago, and will still be making in the future, which is really interesting because we have so much data and information and historical record about what works in investing, and yet we're still making the same mistakes. Why is that? I think there could be a lot of explanations for that question, the biggest of which is just that most investors are not familiar with investing history, even professional investors. But there's another little quirk here that I think is so important. There's a great quote from Voltaire who says, "History never repeats itself, but man always does." History never repeats itself, man always does. I think that is why investors don't learn from history. Because when they think about investing history, people think about the really specific events, the really specific details. Things like, how was General Motors built? How was Silicon Valley grow to what it is today? What caused the Great Depression? Those are the events that people think about with investing history. And that's fine. That's all interesting information. But history never repeats itself. So a lot of the details from those events are just not relevant to making future decisions. There will be new Microsofts in the future, but their history is never going to be exactly like Microsoft's was in the past. There will be more Silicon Valleys in the future, but their origin stories will not mimic what Silicon Valley's was. So history never repeats itself. But man always does. The behaviors around how investors think about greed and fear and risk and opportunity, those never change. And I think one of the biggest insights that we can have from investing history is that rather than focusing on the specific details of what happened, I think you can gain the most insight from history by looking at the behaviors that repeat themselves over and over and over again. And then even if you are a passive investor, or even especially if you are a passive investor, I think these behaviors are some of the most important things that you can think about and learn from investing history. I've always believed that investing is not the study of finance. It's a study of how people behave with money. That's really what investing is. And the thing that's hard about behavior is that behavior is hard to teach, even to very smart people, because you can't sum it up in charts or datas or formulas. It's just a soft and mushy topic. So we tend to ignore it. It tends to get swept under the rug in investing, even if it's the most important aspect of successful investing. And so what I want to do with you now is share with you 4 stories, none of which have anything to do with investing, but all of them, hopefully you will see, have a very clear takeaway about how we as investors, and specifically passive investors, can think about risk and think about opportunity in a better and more productive way. So the first story that I want to share with you today is that you could be wrong half the time and still do great. And this story has nothing to do with investing or finance or money. The story has to do with the development of babies' brains. Might sound interesting, but here's where I'm going with this. The average child is born with about 100 billion brain neurons. And each one of those neurons has about 3,000 synaptic connections, which are these connections to other neurons that forms this web of intelligence inside of your brain. Maybe when a baby is born, that web looks something like this. By the time the average child is 6 months old, that has increased from 3,000 to 6,000 synaptic connections. So the web of intelligence inside of your brain is growing exponentially. By 2 years, that's increased to about from 6,000 to 10,000 synaptic connections. So just an incredible amount of growth inside of this web of knowledge in your brain that takes place in the first 2 years of life. And then after 2 years, something very interesting happens, which is that the number of synaptic connections in your brain does not just peak and plateau, it starts to decline. And it declines fairly rapidly. By the time the average child is 4 years old, they've already lost about 1/5 of the synaptic connections that they had in their brain at age 2. By the time the average child is 6 years old, they've lost 1/3 of these connections in their brain that they had when they were 2 years old. And this actually continues all throughout childhood, all throughout your teenage years, into your early adult years. By the time the average adult is 25 years old, they've lost half of the connections in their brain than they had when they were 2 years old. Why does this happen? Well, it turns out that a lot of the learning that takes place in the first few years of your life is learning in these brain connections that are redundant, that are not wired very well, very efficiently. Sometimes it's learning that is just not relevant to the real world. Sometimes it's connections in your brain that are completely miswired. There's some evidence, particularly in the first few moments of a newborn child's life, that some babies can hear colors and smell sounds because the part of their brain that processes that information is totally miswired. And so you go through a lot of the early years of your life shedding and getting rid of these inefficient, redundant, unnecessary connections. But what's so important about this is that even though what's going on inside of your head is loss and destruction, you're still getting smarter. A 4-year-old is way smarter than a 2-year-old. And a 25-year-old is way smarter than a 4-year-old. Most of the time, at least. We all know some exceptions, of course. But this idea that what's going on inside your brain is loss and chaos instruction, even though you're getting smarter, is not very intuitive. Because you can imagine if you were a parent and you could look inside your child's brain every morning and see that they had fewer connections than the day before, you would panic. You would say, this isn't right. This doesn't feel like how it's supposed to work. I need to make an intervention, even if that is the normal path of growth over time. The idea that something can improve over time, even though what's going on inside is loss, is not very intuitive, but we see it very often in a lot of fields. And one of the fields I think we see it so often in that is easy to ignore how powerful it is in investing, particularly passive investing. And I'll show you what I mean. This is the Russell 3000, which is an index of large companies in the United States going back to 1980. And this is an amazing return, average annual returns of 12% per year. Yeah, there's some volatility in here, but really good return. This is like as good as it gets for a large nation's stock market. But if you look at what went on inside of this passive index during this period, how these 3,000 individual companies actually performed during this period, you get a totally different view. What you'll see is that the median stock in the index underperformed the average by 54 percentage points. 40% of companies in the index lost money during this period. The huge majority of those lost all of their value, not because they were bought out or merged with another company, because when they went bankrupt, 40% of the companies in the index fell for that. Roughly all of the index's returns comes from 7% of companies that had extraordinarily high returns. So here again, you start with an index that has done so well over time, but then you look at what actually happened inside of the index, and it is a constant chain of loss and destruction. And this has a big impact on how we think about volatility in the stock market as well, for passive investing. This is the S&P 500 going back to its inception in 1957. And this is like the picture of success for passive indexing. This is like you made 200 times your money during this period. This is as good as it gets if you are a long-term investor. If we can repeat this performance over the next 70 years, that's as good as anyone can hope for. But this I want to show you, that is when the index was down 5% from its previous all-time high. That's when it's down 10% from the previous all-time high. And that's when it's down 20% or more from the previous all-time high. So you start here with like as good as it gets for a passive investor, but then you layer on the nuance of what actually happened during this period. And it's a constant chain of loss and destruction. And what's so important is that at every one of the bars on this chart, you have investors all over the world, good investors, smart investors who think they've stumbled across a stock market that doesn't work for the first time. And they say, this can't be how it's supposed to work. I want out. And so they sell, and they think they're doing something good for themselves. They think they've discovered a stock market that's broken for the first time ever. Even if what they are experiencing as a passive investor is just the normal path of long-term growth over time. And let me show you how accentuated this is if you are a stock picker. And I know this is a passive investing conference, but this point I think really drives home the point I'm trying to make. This is Netflix stock from 2002 to 2018. I just grossly cherry-picked the best returns that you can think of from a large cap company. You made 500 times your money during this period. This is cherry-picking with hindsight. This is like as good as it gets if you're a stock picker. But these are the losses that you had to endure, the drawdowns that you had to endure to actually achieve those returns over time. And this is why the percentage of active investors who will hold a stock like Netflix rounds to zero. It's so few people who can actually do it, because it's just not intuitive to think that on your way to earning 500 times your money, you're going to lose 70% of your money twice. You're going to lose half your money on 5 separate occasions. That's just not an intuitive thing to think about, even if that is the normal path of growth over time. There's a great quote that I love from Napoleon, who was once asked the definition, of a military genius. And Napoleon said, a military genius is the man who can do the average thing when everyone else around him is losing his mind. And I think it's the exact same in investing. That good investing is not about making great decisions, especially if you're a passive investor. It's about consistently not making mistakes, consistently not screwing up, and just making sure that you are not consistently reacting to the chaos and loss and destruction that is so normal in the market that might pull you away from a passive investing strategy that might earn the highest returns. Charlie Munger has a great quote that summarizes this really well. He says, the first rule of compounding is to never interrupt it unnecessarily. It's a great quote. I love it. That's the first story to share with you today. The second story is that timing is meaningless, but time is everything. And this too is a story that has nothing to do with investing. I want to tell you a story about this moment right here. And most of you will recognize what this moment is. This is the first second of the first flight in human history. December 17th, 1903, the Wright brothers in Kitty Hawk. And it's hard to overstate how important this moment was for the world because the airplane changed everything in the world. It completely revolutionized not just transportation, but communication and military geopolitics. The airplane started world wars. It ended world wars. Like nothing in the world was the same after this moment and after the airplane came into use. And the amazing thing about this moment is that you don't need any scientific knowledge to understand how big a deal this is. This is not like mapping the genome where you need to be a scientific expert to even understand what's going on. This is just a guy flying through the sky for the first time ever. And so you can imagine how exciting this moment was for the world and how journalists all over the world were coming together to talk about how the world was changed forever now that we could fly in an airplane. Except that is not at all what actually happened next. This is the front page of the New York Times from December 17th, 1903, the day of the Wright brothers' first flight. And it's tiny print here, but you can take my word for it. There was no mention of the Wright brothers in there anywhere. This is the next day, December 18th, no mention anywhere. And the 19th, and the 20th, and the 21st, and the 22nd, no mention anywhere about what the Wright brothers were doing. This went on for days, it went on for months, it went on for weeks, it went on for years. 2 years after the Wright brothers first flew, the New York Times did an interview with a German hot air balloon tycoon, as you can see here. And they asked this German hot air balloon tycoon if humans would ever fly in an airplane. Because a lot of people were trying back then. People were talking about it. And what he said was, quote, in the very, 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 very far future, there may be flying machines, but not now, not now. That's 2 years after the Wright brothers' first flight, and the largest newspaper in the country did not even know they had done it yet. The most amazing thing about the Wright brothers' first flight is that no one paid any attention to it after they did it for years. There was, in fact, one newspaper that covered the Wright brothers' first flight. It was the Dayton Herald. The Wright brothers are from Dayton, Ohio. And this is how they covered it here. Just Dayton boys solve problem. Like it's a bunch of silly kids that had no meaning in the world and didn't have any significance. The editor of this newspaper was a guy named Luther Beard. And Luther Beard was asked years later why he was the only journalist to cover the Wright brothers' first flight. And what he said was, quote, I used to chat with them, the Wright brothers, in a friendly way because I sort of felt sorry for them. They seemed like well-meaning, decent enough young men, yet there they were wasting their time day after day on that ridiculous flying machine. So the only journalist to cover the Wright brothers' first flight did it out of sympathy for these poor kids. Now, after Kitty Hawk, the Wright brothers went back to Dayton, where they're from. And Dayton is really where they mastered flying. They were flying like all over people's homes and through the center of town, like flying the airplane all day, every day around town. David McCullough writes a great biography of the Wright brothers, and he talks about this period back in Dayton. And he writes, quote, not one reporter bothered to attend during this time, nor did public interest increase. With few exceptions, there seemed to be no public interest at all. No local excitement or curiosity or sense of wonder over the miraculous thing happening right in Dayton's own backyard. Which to me is just astounding. Like in due time, the Wright brothers got the credit and the recognition that they deserved, of course. But it took years. It took them about 5 years to build the airplane and then another 5 years before anyone was paying any attention to it. And this is so important because if you think about the traits of successful entrepreneurs, people think about things like creativity and ingenuity and maybe your marketing ability, things like that. Rarely do you think about patience and time horizon as a competitive advantage. Or to the extent that we do think about time horizon as a competitive advantage, it is so easy to underestimate how much time is needed to put the odds of success, or in this case, the odds of recognition, in your favor. And that is also true in investing. I'll show you what I mean. This is Warren Buffett's net worth over the course of his life. From age 14, when he had about $5,000 in the bank, till today, when he is 90 years old and he's worth about $100 billion. This is how it played out over the course of his life. And something that is so astounding to me about this chart, no matter how many times I think about it, it's just shocking to me, is that 99% of Warren Buffett's net worth was accumulated after his 50th birthday. And 97% came after his 65th birthday. That's just how compounding works. It's not something that takes place over a year or 10 years or even 20 years. Compounding is a lifetime endeavor. And it's just so easy to underestimate how much time is needed to put the odds of huge success in your favor. Because we spend in this industry so much time and so much effort trying to answer the question, how did Warren Buffett do it? How did he become so successful, so rich? And we go into grand detail about how he thinks about business models and market cycles and management teams, those kind of topics, which are important topics. Those are great. Even if we know it's just a matter of simple math that the answer to the question, how did Warren Buffett do it, is that he's been a good investor. Yes, he is a good investor, but he's been a good investor for 80 years. That's what makes all the difference in the world. It's just so easy to underestimate how powerful time has played in his success. And this is true for us mortal passive investors as well. What this shows is in the United States, going back to the 1870s, the maximum and the minimum annual returns you could have earned in a passive stock market based off of holding period. So if you held stocks for 1 year or 5 years or 10 years, what's the most you could have earned annually and the least you could have earned annually? That's what this shows. And something that should stick out from this chart is that it is not until between 10 and 20 years that every holding period finishes with a positive return in a passive investing strategy. Not a good return, not losing money after inflation, between 10 and 20 years. And this is so important because if you ask most investors, are you a long-term investor? Most investors will tell you yes. Most investors think they are long-term investors. But then if you ask them, what does long-term mean? What's the definition of long-term? A lot of investors will tell you 1 year. That's the long-term. Maybe 5 years is the long-term. 10 years definitely feels like the long-term, especially if you are in retirement. Even if we know that a good definition of what long-term is, that definition being just not losing money in a passive strategy, is something between 10 and 20 years. So it's just so easy to underestimate how much time is needed to put the odds of success in your favor. I think we have to remind ourselves as investors that when progress is measured generationally, results should not be measured quarterly, especially if you are a long-term investor or a long-term passive investor. The central problem that investors have is the idea that compounding is never intuitive. So almost all investors underestimate how much time is needed to put the odds of success in their favor. Even for passive investors who are really, not necessarily concerned about what the market is going to do this week or next week, it's so easy to underestimate how powerful time is and how much time you might need to do well over time. So that's the second story for you today. The third story is that risk is what you don't see. And this too, of course, is a story that has nothing to do with investing. I want to tell you a story about this guy right here. This is Harry Houdini, one of the great magicians of all time, who did most of his work in the United States about 100 years ago. And Houdini, of course, was known for his escapes. He would tie himself up in chains like you see here, or he would wrap himself in a straitjacket and he would throw himself in a river or bury himself in dirt and he would escape. He was the best in the world at this. This is what he became famous for. But Houdini had another trick that he played during every show, that he was not very famous for, but the audiences absolutely loved it. And what he would do is at the end of every show, he would invite the largest, strongest man onto stage, and he would tell that man to punch him in the stomach as hard as he could. His claim to fame, Houdini's claim to fame, was that he could flex his stomach in a way that would absorb any man's punches. So he would invite the guy onto stage and the guy would sit there punching him and Houdini wouldn't even flinch. And the audiences loved it. They had a different sense of humor back then than we have today. But one day after a show in 1922, Harry Houdini went back to his dressing room and he invited a group of college students back there to meet him. One of the college students was a guy named Gordon Whitehead, a skinny little 19-year-old kid named Gordon Whitehead. And Gordon Whitehead walked up to Harry Houdini and without warning, he started punching him in the stomach as hard as he could. He didn't mean any harm. He wasn't trying to hurt him. He just thought he was performing the trick that he had just seen on stage. But Houdini was not prepared to be punched. He didn't see this coming. And all of a sudden, he was in a lot of pain. And he explained to Gordon Whitehead that the trick only works if he's prepared for it. if he's flexing his stomach. And since he wasn't prepared for it, now he's in a lot of pain. He just kind of got sucker punched. Gordon Whitehead apologized profusely. He felt terrible. But Harry Houdini went to bed that night, doubled over in pain. He woke up the next morning. He couldn't even get out of bed. He was in so much pain. His appendix had ruptured the night before, almost certainly from Gordon Whitehead's punches. And Harry Houdini died later that day. This is how he died. And what is astounding to me about how Harry Houdini died is that he was like the world's foremost expert in surviving big risks. That was what Harry Houdini did. Wrap himself up in chains and throw himself in a river, that's no problem for him. He can survive that because he has a plan. It wasn't a surprise. He knew what was coming. The one risk that he can't survive, the one thing that kills him, is just a skinny little kid's punch to the stomach that he didn't see coming. That was a surprise. And what that shows is something that I think is so important for a lot of fields, which is that how risky something is depends on whether you're prepared for it. Not how big a risk you think it is or how much damage you think it can cause, but just whether it's a surprise or not. And how starkly have we all learned that in investing over the last 18 months or so with COVID? This, I think, is the biggest takeaway from COVID in terms of economic and investing takeaways, particularly for passive investors who are just looking at long periods in the stock market. The biggest economic risk is what no one is talking about. Because if no one is talking about it, no one is prepared for it. And if no one is prepared for it, its damage is amplified when it arrives. That, to me, is the biggest takeaway for investors over the last 18 months. And I'll show you what I mean about how damaging this can be to investors. We spent in the United States the better part of the last decade debating the question, what is the biggest economic risk? What's the biggest risk out there for investors that people should pay attention to? That's what takes up 90% of the oxygen in this industry. And we tend to personify these risks. So we asked for the last decade, was this guy the biggest risk? Was it former President Barack Obama? The tax hikes of 2013, was he the biggest risk to the economy? Was it this guy? Was it Ben Bernanke, the former chairman of the Federal Reserve? All the money printing after the financial crisis, was he the biggest risk? Was it this guy? Was it Donald Trump? All the craziness of the last 4 years, was he the biggest risk to the economy? This is what we talked about all the time, took up all the oxygen in the space for a decade. And the amazing thing about this story is that we now know in hindsight that the answer to the question, who's the biggest risk to the economy, to our investments, is none of these three guys. By an order of magnitude, it was this guy here. It was a virus that no one saw coming, that was not in any economic outlook, no analyst forecast, until the moment it arrived and millions of people lost their jobs in 1 month. The biggest risk by far is what no one saw coming. And again, I think if you look historically in investing, that's always the case. I mean, the risks that we talk about as investors are things like trade wars and next quarter's earnings and budget deficits and elections. This is what's in the newspaper all day long. And it's not that these things aren't risky. It's that they're not surprises. We talk about them all day, every day in the newspaper. Maybe you don't know who's going to win the election, but you know there's going to be an election. It's not a surprise to anyone. But if you look historically, what actually moves the needle for investors, what actually makes the biggest difference in hindsight, it's things like COVID-19. And Lehman Brothers couldn't find a buyer in 2008 that started the financial crisis. September 11th terrorist attacks, Pearl Harbor that dragged America into World War II. Those are the events that actually make the biggest difference in hindsight, that move the needle the most. And the common denominator of those events is not that they were big, it's that they were surprises. It's just that no one saw them coming until the moment that they had arrived and did all of their damage. The biggest risk is what you don't see coming. Carl Richards, who's a great financial advisor, has a quote that I love. He says, "Risk is what is left over when you think you have thought of everything." I think that's the best definition of risk that exists. And that could be kind of disheartening to hear. It kind of makes you feel like you're just putting yourself out there and crossing your fingers and hoping for the best. We don't know what's going to happen next. But I think there's two ways to think about risk in this world when risk is what you don't see coming. The first is the idea of expectations instead of forecasts. This is so important, especially for passive investors. I think the best way that we can think about risk is having expectations instead of forecasts. I'll tell you the difference. If I were to say, just hypothetically, The next recession will arrive in June of 2023. I'm just making that up. That's a forecast. But if I were to say, historically, there are about 2 recessions per decade on average, and I expect that to be the case going forward. I don't know when it's going to happen. I don't know what's going to cause it. I don't know how it's going to affect the stock market, but 2 recessions per decade on average, that's my baseline expectation. That's not a forecast. It's just an expectation, but it's a much more reasonable way to think about risk in a world where risk is what you don't see. Same for bear markets and market declines. I have no idea when the market is going to have the next bear market. No clue. And I don't think anyone does. But I expect as a passive investor, that at least once a year, my portfolio will decline 10%. At least every 3 years, it'll decline 20%. Maybe once a decade, it'll decline 30% or more. That's just my expectation, even if I don't have a forecast for it. The other thing to think about here is understanding the difference between getting rich and staying rich. They are 2 very different skills that need to kind of be nurtured on their own. Getting rich requires being an optimist, swinging for the fences, being optimistic about the world's ability to solve problems, optimistic about your own abilities in your career. That's what you need to get rich. Staying rich requires almost the exact opposite. It requires a degree of pessimism and conservatism, and just the acknowledgement that all of history is a continuous chain of surprises and setbacks and disappointments and recessions and bear markets and pandemics that you need to be able to survive financially, to endure financially, for your long-term optimism to actually pay off. That's the third story to share with you today. The last story, maybe my favorite story too, is getting the goalposts to stop moving. And again, a story that has nothing to do with investing. I want to tell you a story about this guy right here. This is Stephen Hawking, who was, without exaggeration, probably the smartest human to walk the planet over the last 100 years. I don't think that's any exaggeration at all. Stephen Hawking was just an absolute savant, an absolute genius who understood astrophysics and how the universe works better than almost anyone. And a quirk of Stephen Hawking's, of course, was that he had a motor neuron disease and he was paralyzed from head to toe. He had no control over his body. He spoke through a computer. And he was not born like this. Stephen Hawking was born as a perfectly healthy child, and he grew up as a healthy kid and even grew up as a healthy, able-bodied adult. He was an athlete in college. He rode crew when he was at Cambridge. And he became afflicted with this disease at age 21, and he kind of lost control over his body after that. Now, a few years before Stephen Hawking died, he did an interview with the New York Times. And during the interview, he started talking about how happy he was with life, and how amazing his work was, and how excited he was to be doing his research, and just about how great his life was. And the New York Times asked him an interesting question. They said, "Are you always this happy?" And I love Stephen Hawking's answer. What he said was, quote, "My expectations were reduced to 0 when I was 21. Everything else since then has been a bonus." And I love that idea, just the idea that how much value you gain out of anything in life is not about your circumstances. It's your circumstances relative to your expectations that makes all the difference in the world. That is a really powerful idea that impacts a lot of things in life, including, let's say, if not especially, how we think about money. And I'll show you what I mean. If you ask Americans, when was the greatest period in the history of our country economically? What was the best decade economically in the history of the United States? Overwhelmingly, Americans point to one decade that was the golden era of economic prosperity, and that is the 1950s. This is what we remember as the golden age of prosperity in the United States, when anyone who was willing to work hard could have a good, high-paying job, dignified life, support your family. And this is not just hindsight. We knew it at the time that the 1950s were like an amazing period economically. Life magazine, where I got this picture, they wrote in 1953 that, quote, "The present and immediate future seem astonishingly good. The country has just lived through what was economically the greatest year in its history." So we remember today, and we knew at the time that the 1950s were like as good as it gets, way better than today. That's how Americans think about it if you ask them today. And to me, what is amazing about this nostalgia for the 1950s, this yearning for the 1950s, is how easy it is to show with just some basic statistics that we were not better off back then, that we are so much better off today. Let me show you what I mean. The average income in the United States, the median income adjusted for inflation in 1955 was $29,000 per year. By 1965, that was about $42,000 per year. And last year in 2020, it was $64,000 per year. So we are the average, the typical family adjusted for inflation, double the income now that they did back in the gold for. And you keep going on down the list of what it was like during the supposed golden age. The average house in the 1950s was 37% smaller than the average house today. The average house in the 1950s had 1 bathroom for 4 occupants. Today we have 3 bathrooms for 2 occupants. We've completely flipped it on its head. The average house spent 29% of an average household's budget in the 1950s compared to about 13% today. Workplace deaths were 3 times higher back then than they are today. And half of men over age 65 were still working in 1950 compared to about 23% today. Most Americans in the 1950s just worked until the day that they died. That was the expectation, that was the reality, and the idea of saving for retirement or even having a retirement was just not on people's radar. And you keep going down any statistic you can think of, almost any way you look at the numbers, we are so much better off today than we were back then. So then the question is, why do we have this nostalgia for the 1950s? Why do we yearn for the 1950s? And there could be a lot of explanations for that question, but I think that one of the most powerful is this. The 1950s were a very unique time in the history of the United States and much of the Western world because there was very little wealth inequality, much less wealth inequality than we do today. The gap between rich and the poor was just a fraction back then of what it is today. You did not have CEOs earning 1,000 times what their workers earned back then. There were no athletes making $50 million per year. You didn't have hedge fund managers who were accumulating billions of dollars. It just did not happen back then. A lot of that was just kind of an echo from World War II in terms of how businesses were managed. The top marginal tax rate was 94% throughout periods in the 1950s. Just a very different time economically where the gap between rich and poor was much smaller. And I think what that did to the average household at the time is it just made it so it was an era where it was very easy to keep your expectations in check. Your definition of a good life, your expectations, your aspirations for what you wanted economically in life, it was easy to keep those expectations in check because your aspirations were not being inflated by a very small number of extremely wealthy people who were setting the bar for what a good life was. So the lower incomes back then felt okay because that's what everyone else earned. And the smaller homes felt fine because everyone else lived in a small house. And going camping for a vacation was fine because that's what everyone else did. Just an era where it was easy to keep your expectations in check. And I think what has happened in the Western world and much of the world over the last 70 years is our incomes have doubled, but our expectations have more than doubled. So it feels like we were better off back then, even if we are so much wealthier today. And what that shows is something that I think is so important, no matter where you live or how much money you make, which is that if your expectations grow faster than your income, you will never be happy with your money. I think this is like an iron rule of finance that has to be obeyed no matter how much money you earn. Just an acknowledgement that wealth is a 2-part equation. You need to do 2 things to become wealthy. You need to grow your income, grow your assets, grow your net worth, and keep that net worth in check relative to your expectations. And it is so easy to ignore the latter half of that equation. And this is why so many people, if they are lucky enough to have a rising income or rising net worth, it never really feels as good as it should or as good as you thought it would because your expectations are rising just as fast, if not faster. And I'll show you an extreme example of what happens when you don't keep your expectations in check. Most of you will recognize who this is, who this jerk is, Bernie Madoff. The biggest financial fraudster of all time, of course, his Ponzi scheme stole $20 billion from investors. A really fascinating part of Madoff's story that did not get much attention when he was caught in 2008 is that if you go back to the 1980s, before Bernie Madoff's Ponzi scheme began, he was earning, by some accounts, $30 million per year from the legitimate side of his business. Not the fraud, from the real business that was a real, actual, legitimate business. He was earning $30 million a year. He was honestly, without exaggeration, one of the most successful businessmen in the world before his fraud began. And what is astounding to me is that despite being that successful, that rich, He wanted more so badly that he was willing to start this fraud that ruined everything. And now look, if you are broke and you have a starving child at home and you go out and rob a grocery store, that I can wrap my head around. That kind of makes sense to me. That's something I can understand. But if you are this wealthy and you want more so badly, your expectations are so high that you go out and start this fraud that ruins everything, that to me is just fascinating. And Madoff, of course, is like the most extreme example. He's a psychopath. But I think most of us, not all of us, have some little element of this inside of us. That if we're lucky enough to have a rising income, but our expectations rise just as much, we're never going to feel satisfied with what we have. Several years ago, two very famous writers were having dinner at the house of a hedge fund manager in the Hamptons, Kurt Vonnegut and Joseph Heller. And Kurt Vonnegut turned to Joseph Heller and he said, "Joseph, do you know that the hedge fund manager who owns this house has earned more money this month than you have earned in your entire life?" And Joseph Heller said, "That might be true, but I have something that the hedge fund manager will never have, and that is enough money." This word, I think, enough, is probably the most important word that exists in all of financial planning, thinking about our money. Because if you don't understand what enough is, if you don't go out of your way to define what is enough for you, not just enough net worth, but enough risk that you want to take in your investments, enough time that you want to be working in your career away from your family, if you don't define what enough is for yourself, you will learn about it the hard way. When you end up taking too much risk and it backfires. When you've worked too hard in your life and you haven't spent enough time with your family. If you don't define risk, or if you don't define enough, you will learn about it the hard way. So if there's a common denominator from those stories today, it's that when people tend to think about risk in investing, in passive investing, they usually think about what's going to happen to them. What's the market going to do to me? What's the economy going to do to me? That's how people think about risk. I think a much better way to think about risk is just what we do to ourselves. It's our own biases, our own impatience, our own misconceptions. That's what does the most damage to investors over time. And that's actually a pretty optimistic realization because, of course, you have no control over what the stock market is going to do next or what the economy is going to do next. The only thing you can control as an investor is your own behavior. And when you realize that behavior is the single most important aspect of successful investing by far, that's a pretty optimistic realization. So I want to end with you today with a quote from an investor who I really admire. This is so important for passive investors especially, who says, "People do not get what they want or what they expect from markets. They get what they deserve. It all just comes down to how you behave." And my screen share right there because those are the end of my prepared remarks. But thank you so much for listening. I think we have some time now for some questions, but it's been an honor and a pleasure to get to speak with you this morning. Thank you very much.
Great. Thank you so much, Morgan. I think that was a phenomenal presentation. I was just taking notes from your presentation. It was a great learning experience, and we've got a lot of comments, also appreciations on our YouTube channel. And we've got a bunch of questions as well. So I would love to start off with a question about the psychology of dollar cost averaging. In India, the most common way of investing in a mutual fund is through something called an SIP or a systematic investment plan, which is similar to dollar cost averaging. So why hasn't that taken off in the US? And wouldn't that solve a lot of problems related to psychology of timing and mistiming and all of that?
It does. Well, here's the thing about dollar cost averaging. If you back test it and look at history, it's almost impossible to beat dollar cost averaging. Exactly. It's just like, even with hindsight cherry picking, it's hard to beat it. So in theory and the data, it makes perfect sense.
Yeah.
But it's just so hard psychologically to do it because when the market has fallen 20 or 30%, to keep making those contributions takes a lot of effort, takes a lot of mental willpower to actually hit buy and to actually do it. What's important is that dollar cost averaging only works if you are making those contributions at the market bottom. Those are the most important contributions that you make. And so I think it's always the case that it is easier to say, I will be greedy when others are fearful, than it is to actually do it. And if there are programs, and there are some of these in the United States as well, where you can really systematize your investing decisions and just set up an automatic plan so that you don't have to make any decisions. It just automatically happens. That's a phenomenal way to invest. And actually in the United States, most small investors, how they invest in the stock market is through their 401k retirement plan.
Yeah, exactly.
And how they actually do invest in that are they're adding money out of every paycheck. Every 2 weeks, it automatically goes in the stock market. They don't have to do anything. That's the huge majority of how people invest in the United States. So there actually is quite a bit of dollar cost averaging that takes place. It's the stuff that you have to do on your own that is so much harder and so easy to underestimate how you are going to feel when the market is declining.
Great, thanks. So the second question, and this is obviously, since you're a big student of history, what we've seen is if you look at the wealthiest people in the world, they've made their wealth over the last, say, maybe 50 or maybe maximum 100 years. Why don't we have, wealthy people from the 1800s or the 1700s? What happens during such a long time frame? Why doesn't compounding work?
Well, there are very wealthy people during the 17 and 1800s, the Carnegies, the Rockefellers and whatnot. I think what is great about this era is that now we have the opportunity for average, ordinary people to achieve long-term wealth because around the world, you have low-cost passive indexing. That did not exist 20, 30 years ago, to say nothing of 100 years ago. So I think the era that we're living in now has the highest chance in all of human history for ordinary people to become wealthy. That's true in the United States. I think it's true in India. It's true all over the world. Doesn't mean it's easy. Doesn't mean everyone who wants to do it can do it. But the highest odds of it occurring that have ever existed in human history. I mean, if you go back to the 1800s or the early 1900s, wealth was so concentrated and opportunity was so concentrated among a very small number of individuals, the robber barons of the day, that, look, it was not impossible. There's always going to be stories of ordinary people achieving great fame and fortune. But the odds, I think, are so much higher today, particularly in a digital era where it almost doesn't matter where you live or who you know, or whether you live in New York or Mumbai or Los Angeles or London, doesn't necessarily matter. In a digital era, like, what matters is your talent, your meritocracy. So I think that's a huge reason for optimism today and looking forward, is just the odds of becoming wealthy from investing or entrepreneurship, whatever it is, I think are greater today than they've ever been.
Great. So the next question is, about, what are some of the things that are at least happening in today's market that, make you wonder and, question, a lot, like maybe some guy, because, we are in a bit of a very, very sort of unique phase in, especially in the markets today. So anything that strikes out to you that's very interesting?
Nothing that really worries me, but I think it's so obvious that if you look around the market today, that there are investors who play very different games from one another. And if you are a passive indexer over time, that's one game. But you can also be a day trading meme stocks, and that's another game. You can be a high frequency trader. That's a completely different game. You can be a concentrated stock picker. That's a different game. And so we're all in the same field, so to speak. We're all on the same pitch, but we're all playing very different games. And the danger, I think, that exists, that is maybe more dangerous today than ever, is that if you are a long-term passive investor, but you are watching what's happening with people day trading meme stocks, all the craziness that's going on with meme stocks, and you start taking your cues from those people, and you start saying, maybe they know something that I don't. Maybe that's what I should do with my money as well. And you start like mixing games apart. And if you are a long-term investor, but you're taking your cues from those people, it's easy to fall into traps that a lot of investors fall for. This is really true during the peaks of bubbles when, if you are a day trader, then the valuation of a stock does not matter. Whether a stock is completely overvalued makes no difference to you. All that matters to you is that stocks are going to go up. That's the only thing that's important. But if you're a long-term investor and you're looking at the price action in those stocks and saying, maybe these people know something that I don't, maybe I should buy this company, that's when people really get into trouble. It's when people haven't gone out of the way to define what game they're playing and only take their information and their cues from people who are playing a similar game. And I think the spectrum of games that investors play these days is wider than maybe it's ever been, from the day trading meme stocks to the passive investors. And both of those ends have attracted a ton of money. There's trillions of dollars in passive indexing, and there's millions of new accounts on Robinhood that are day trading the craziest companies you can imagine. So kind of both ends of the spectrum have really grown considerably over the last decade. And it's just dangerous when those investors don't understand that they are playing different games from one another.
Great, thank you. I really loved your segment on expectation management, how it's extremely important for someone to generally be happy in life. I think, but looking at, maybe talking from a different lens, one is how do you keep expectations in check, because I think a lot of I would say envy is sometimes required to push humankind to do things which are a lot more riskier, and maybe to push ourselves towards more innovation and just becoming a better species overall. So do you think that there's some way in which we can push ourselves but also keep expectations low?
You're absolutely right that the outside benchmark of comparing yourself to other people is the fuel of a lot of progress.
Yeah.
Like the need to chase whoever is in front, try to do better than them. That's the fuel of all progress and advancement.
Exactly.
So there's that element. But I think at the individual level, it's undoubtedly true that rather than the external benchmark, you want to be focusing on the internal benchmark. Because if your definition of success is just that you are better off and wealthier than the next guy, there's always going to be someone who is getting richer faster than you, who is better looking than you, who is smarter than you, who is more talented than you. That's always going to be the case. And if that is your only definition of success, you need to come to terms with the fact that you are never going to be happy. You are never going to be satisfied, I should say. But if you kind of switch to the internal benchmark of just saying, what are my personal goals? Am I meeting those goals? Have I progressed over the last 5 or 10 years? Have I grown my income over the last 5 or 10 years? If you're focusing on that internal benchmark more than the external benchmark, or just going out of your way once in a while to think about the internal benchmark and how far you personally have come, achieving your goals, doing the best that you possibly can, even if other people are doing better, that's the only way to do it. So I think it's really just finding that mix between the two of being motivated by the success of other people and what other people are doing. But it's still at the end of the day, looking yourself in the mirror, measuring your success and how far you've come individually. It's not an easy thing to do, but I think striking that balance is so important. And very few people do it. I think the huge majority of people are anchored in solely on external benchmarks. Mm-hmm. And that's why if our standard of living around the world has increased so much over the last 100 years, are people happier today? The answer is by and large, no. Some people, yes, but by and large, no. Yeah. And I think the reason for that is because it's just so much external benchmarking in how other people are doing and people measuring their happiness and their success just relative to those around them.
Extremely true. I was trying to avoid this question, but I think we've got a lot of people asking this. But looking at it from a historical lens, since we had barter system, then you had a centralized currency. Now you have DeFi. How seriously should someone like me or someone else take it? In terms of how important it can be in the future.
How seriously should you take it? I think you should take it very seriously. I think the odds, 5 years ago, it was easy to say crypto is a joke.
Yeah,
that was what people had said 5 years ago. That's probably what I said 5 years ago. I don't remember if I said that, but probably that's what I said. I think today, no one should be saying that. The amount of smart people who are in this field, the amount of belief that has gone into it, and the amount of optimism that has gone into it makes it so that it's an actual thing. Like, is there actual intrinsic value of Bitcoin? Intrinsic value, no. But if enough people believe that something is true, it actually becomes true. And so many people, enough people, a critical mass of people have so much faith in something like Bitcoin, just to use it as an example, that it has real value. And I think it will for a long period of time. That doesn't mean it can't fall 90% as it has a couple times in the past. But so many people believe in this system. So many of the smartest people are devoting their career, devoting their lives to making this work. And there's so much capital going into it that no one should be thinking that this is just a flash in the pan, like a puff of dust that's going to go away. That's not the case. There is also a long-term history, I would say, of whenever you have a promising industry, actually picking the winners that are going to come out for that is a completely different thing. I mean, the example from the car industry in the United States, if you go back to the early 1900s, there were 2,000 car companies, and those ended up as 3 car companies. 3 car companies made it, GM, Ford, and Chrysler, 2 of which went bankrupt. So even if you find a promising industry, finding the winners from those, the long-term winners, is completely is a totally different thing. Same thing with computers. Like, who are the winners? The winners were not Commodore Computer and IBM, at least over the long term. It was companies that no one was talking about 20 or 30 years ago, from the internet, Facebook and Google and whatnot. Microsoft is probably the sole example of like a industry leader that has been relevant for more than 30 years. That's a very rare thing. So finding a promising industry and finding promising long-term investments are very different things. So DeFi and crypto is not necessarily my space, but 5 years ago, I probably would have laughed at it. And now I definitely would not bet against it, even if I don't own any per se.
Great, thanks. So we just wrap up with one last question. And this comes from portfolio management. I think as a financial advisor, as someone who advises people on how to set up their investments, the biggest I would say problem I get is convincing people to not speculate. Inherently, our genetics are all sort of built towards speculation. So my I would say conclusion is that you should maybe put 90% of your wealth towards something which is long-term passively managed products, and then maybe you can speculate or try out with those 5 or 10%, because it's very hard for you to say no to something that inherently you want to do. So what would your advice be for someone who wants to do portfolio management but also wants to I think try out his hands on speculation and stock trading and all of that?
I think you're absolutely right. Here's how I would frame it.
Yeah.
Your investing success is all going to be determined by how long you can stick around for, how much you can endure, how long you could actually invest for. And if day trading, creating crazy penny stocks is going to satisfy an urge for you and scratch an itch for you so that you can actually leave the other 90% of your investments alone and let them compound, that's a great thing. Like, there's so much evidence that an imperfect investing strategy that you can stick with will outperform a quote unquote perfect investing strategy that you're likely to abandon. And so if there are people that really have an urge to speculate and trade, and I get that, there's no criticism there whatsoever. I like that too. Just as long as you're doing a small portion of your money and satisfies your urge, and that the majority of your investments are really for the long term where the odds of success are firmly in your favor, then I think that is a perfectly appropriate way to invest. I'm not the kind of person who is like such a purist that they say every cent that you have needs to be investing appropriately. An imperfect investing strategy that you can stick with is always going to beat the perfect one that you can't.
Great. No, thank you for the insights. I think thank you so much, Morgan, for being out here and delivering your insights. This was a great session, and we're obviously looking forward to more sessions from you. So thank you so much.
Thanks so much for having me. I appreciate it.
Thanks. So that's it, friends. I think thank you for coming in and being with us for our first edition of the Motilal Oswal Passive Funds Conclave. I think this has been a great day, and I hope all of you enjoyed the session. Please do leave feedback for us. We want to do this at least once a year. So any feedback that you can give us will really help in making this a lot better for a lot of you. Next time onwards. And also thank you for taking the time and being out here and being with us. So with that, this is Pratik, and I am signing off for the day. And hopefully we'll meet each other for the second session. And till then, stay safe and have a good night. Thank you so much. Bye.
I miss traveling, yeah.
Even if you can't travel, your money still can.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Why put all your eggs in one basket?
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
So they're low cost, and they're also very effective when it comes to long-term returns. So let's come to the first point.